Okay, good morning, students. Today is 5th of January 2021, and we are going to cover the topic strategic financial management. The subject strategic financial management, and the topic covered will be foreign exchange exposure and risk management. And I'm your faculty, Pravesh Agi, who will be taking through this lecture today. So let's begin. So we have covered a lot of ground so far, and we were, on the topic called hedging currency risk. Okay, so we are doing some exercises, we are doing some questions. So we'll continue to do that till we end it, and then we'll move on to the futures today. Okay, so far we are covering forward contracts. Okay, fine. So let's begin with an exercise. So I hope all the slides are with you. Then we will be starting this exercise number 9. Now, in this question, what it is given is there's a company called ABC Limited of UK. They have exported goods worth Canadian dollars, $5 lakh. Okay, so this is a UK-based company. They have exported goods to Canada, and the amount of invoice is 5 lakh Canadian dollar, receivable in 6 months. Now, this money is going to be received in 6 months' time. The exporter wants to hedge the receipt in the forward market. Fine. So they want to hedge the receipt in the forward market. The following information is available. Spot exchange rate is Canadian dollar 2.5. That means 1 pound is equal to 2.5 Canadian dollars. The interest rate in UK is 12%. And interest rate in Canada is 15%. The forward rates truly reflect the interest rate differentials. Okay, find out the gain loss to UK exporter if the Canadian dollar spot rates decline by 2%, number one, gain by 4%, or remains unchanged over the next 6 months. So before attempting to solve this question, let's understand ABC is basically a company in UK. They are exporting goods to Canada, and they have exported goods worth 5 lakh Canadian dollars, which they are going to receive in 6 months' time. Now, Canadian dollar wants to hedge the receipt in the forward market, so they want to take a forward cover. Okay, so following information is also given. The spot rate is given, and then interest rate differentials. Interest rate is UK is 12%, and interest rate in Canada is 15%. Now we can know from this information that the UK will, trade at UK currency will appreciate by almost like roughly about 3% in say 1 year's time because of this interest rate differential. So a country which is having a low inflation will always trade at premium compared to the country which is having a high rate of interest rate. Now, so either UK will be appreciating by 3% roughly over the year, or Canadian dollar will depreciate by 15%. Okay. And it is also given that the forward rates truly reflect the interest rate differential. That means the forward rate, say after 1 year or 6 months, will reflect the exact roughly about 3% kind of appreciation. Because in this case, it is 6 months. So roughly 1.5% the forward rate will be higher than compared to today. Okay, in terms of pounds. Find out the gain or loss to UK exporter. So we have to find out whether there will be gain or loss to UK exporter, because he's going to cover himself to the forward market if the Canadian spot rate declines by 2%. Now, before solving this question, we must understand, what answers we can expect, because that the Canadian dollar, or say, the pound is going to appreciate by say 1.5% over the next 6 months, because the overall interest rate differential is 3% per annum. So for 6 months, because the money is going to be received after 6 months. So that means the the pound is going to appreciate by say 1.5%, and the Canadian dollar is going to depreciate or decline by 1.5%. But it has declined by 2% in the first case. Okay, so that means the ABC company will be making a gain by taking a forward cover, isn't it? Because if it has declined by say 2%, the spot rate after 6 months, and you have taken a forward cover, which is giving you signifying a decline of 1.5% because of the interest rate differential. So you will be making a gain. I hope you have understood this, because in the first question, it says that Canadian spot rate is going to decline by 2%. Whereas as per the interest rate differential, it is going to decline only by 1.5%. Okay, if it declines, that means the UK's exporter is going to receive less money, okay, in terms of pounds. But he has already taken a forward cover, so he has already factored in almost like 1.5% decline. So actually, it has happened 2%. So he's going to basically make a profit because of taking a forward cover. Okay, so we'll understand while we solve this question. And the second part is gains 4%. Now, if the Canadian dollars gains by 4%, that means, I mean, as per the interest rate differential, actually Canadian dollar should have actually, depreciated by 1.5%. So it has gained 4%. So in that case, he is going to lose money by taking a forward cover. He should have, left it covered had he known that there will be a gain in Canadian dollar by 4%. So that means if the Canadian spot rate gains by 4%, he is going to be, making a loss while taking a forward cover. Now, third is remain unchanged over the next 6 months, which means the Canadian dollar and pound has not made any change. So whatever the spot rate, it remains same. Whereas the Canadian dollar was supposed to depreciate. Okay, so it has not done. So that means it has remained unchanged over the 6 months. So in this case also, the exporter is going to suffer a loss. Fine. So because the Canadian dollar is basically not lost its value, okay, whereas the interest rate differential is reflecting that it will lose about 1.5% over the 6 months. So you have taken a forward cover. So you're, taking a cut about 1.5% in your, forward revenue. So whereas the third part says that it will remain unchanged. So that means you will be making a loss by taking a forward cover. So yeah. Good morning, Chavi and Sumit Jain. Okay, you're quite regular. Fine. So let's understand now. This is a very important, why am I explaining this? That, while you solve the questions in your exam, if you are very clear about, and you can understand the construct of the question, and then you can, visualize, what will be your answer. Instead of, mechanically applying the formulas and calculating, so you can make mistakes. So I told you that in first case, it declines by 2%. That means the forward cover is good for the company. So they will be making a gain. But in the rest of the two, scenarios, if the Canadian dollar gains by 4%, whereas it is bound to lose by 1.5% over the 6 months. So you are, going to lose heavily by taking a forward cover. And let's see that when we solve this question and remain unchanged over the next 6 months. So in this case also, the exporter is going to lose. He's going to make a loss by taking a forward cover. So let's understand. So first of all, we must know, the forward rate. The spot rate is today, one pound is equal to 2.5 Canadian dollars. Okay, so 1 pound is equal to 2.5. So this is a direct quote of pound in Canada. Okay. Now, interest rate in UK is 12%. And interest rate in Canada is 15%. So these are things which are given in the questions. Okay, so the spot rate is given, and the interest rate in UK as well as Canada both are given. So this implies that the UK is going to appreciate, the pound is going to appreciate by 3% per annum, whereas the Canadian dollar is going to depreciate by 3% per annum, roughly. Okay. Now, if you have to calculate the 6 months forward rate, so we'll use a formula. Okay, if you remember that the formula is, forward rate is equal to the spot rate multiplied by the home currency interest rate divided by the foreign currency rate. So we have exactly done this. Okay, so 1 pound is equal to 2.5 Canadian dollars multiplied by 1.075, because the interest rate in UK is Canada is 15%, and in UK it is 12%. So it is for 6 months. So we have reduced it by half. Okay. So we calculated the 6 months forward rate, which is 1 pound is equal to 2.535 Canadian dollars. Okay, so I have explained this through the process. Okay, we use this formula. So forward rate is equal to spot into 1 plus interest rate of the home currency into the number of days divided by 360, 1 plus interest rate of foreign currency, okay, into the number of days divided by 360. So this is the formula that we have used. So if we use this formula, so 6 month forward rate will be 1 pound is equal to, say, Canadian dollar 2.5 into 1.075 divided by 1.06. So which means the 6 months forward rate will be 1 pound is equal to 2.5355. So which means that pound has appreciated. Okay, fine. So it was 2.5. Now the pound is going to 2.5. So which also means that the Canadian dollar had depreciated. Okay. So let's now solve the question. The first question says, gain or loss if the Canadian spot rate declines by 2%. Okay. So we have to calculate the gain or loss if the Canadian spot rate declines by 2%, which also implies that the pound is going to appreciate by 2%. If the Canadian dollar is going to decline by 2%, then the pound is going to appreciate by 2%. Now, I told you that in this case, this person would be very happy because, you know, he has already factored in about 3% per annum kind of, decline in the forward rates, or roughly about 1.5% for 6 months. So whereas the Canadian spot rate has declined more, so he should be very happy because he will be making a gain by doing so. Okay, so let's check that. Now we know that one forward rate for a pound is 1 pound is equal to Canadian dollar 2.535. So this we have worked out through our formula because the interest rate is truly reflecting the forward rates. So it is given in the question. So now this rate is 1 pound is equal to Canadian dollar 2.5, but we are going to receive Canadian dollars. So we can convert into, we can do the reciprocal and we can convert the quote into a Canadian quote. Okay, so 1 Canadian dollar will be 1 divided by 2.535. So which will work out to pound 0.39448. So then we can say if 1 Canadian dollar is equal to pound 0.39448, then 5 lakh Canadian dollar will be equivalent to multiplied by 0.39448. So simple, if 1 Canadian dollar is equal to so many pounds, that means 5 lakh Canadian dollar will be simply the multiplication. Or we can also do is 5 lakh Canadian dollar divided by 2.535. Sometimes people use this shortcut. Okay, once you are well versed with, you know, how to calculate, you can even do that. Okay, so you get the same answer. So that means you are going to receive 1 lakh. So this amount is in pounds. So you are going to receive 1,97,239 pounds if you take a forward cover. Okay, fine. Now let's now see that if the Canadian spot rate declines by 2%, which also means that the pound appreciates by 2%. Okay, so if the, you know, that the Canadian spot rate today of 1 pound is equal to 2.5. Okay, so 1 pound is equal to Canadian dollar 2.5. Suppose it appreciates, that means the pound is going to appreciate. Okay, so which means the 1 pound will go to 2.55. Okay, so if the Canadian dollar spot rate declines by 2%, which will also mean that the pound is appreciating. So we can just take 2.5 multiplied by 1.02, that is 2%. Okay, and 1 pound will be equal to 2.55. 1 pound will be equal to 2.55 Canadian dollar. Now we can just calculate. Okay, so 5 lakh Canadian pound divided by 2.55. So we applied the shortcut here. So we get 1,96,078. Now look at this. You know, if he had not taken a forward cover, he would have got 1,96,000 because the Canadian dollar spot rate after 6 months has actually declined by 2%. So, you know, if he had not taken a forward cover, he would have got a little less in terms of pounds. But since he has taken a forward cover, okay, so he's getting 1,97,239. So which would mean that he is gaining due to the forward cover. Okay, so here, as we, you know, visualize when we started the question that, you know, the pound is going to appreciate, or say Canadian dollar is going to, you know, decline by 1.5% as per the interest rate differential, which is shown there. Okay, 15% in Canada and 12% in UK. So the interest rate differential is 3% for the per annum. So for 6 months, it will be 1.5%. So, you know, that was factored in the forward rates. Whereas, you know, actually what happened after 6 months, the Canadian dollar actually declined by 2%. So which means it declined more. So it was, you know, quite a sensible decision of the company to take a forward cover. So here, had he not taken, he would have got 1,96,000. Okay. So in this case, he's gaining due to a forward cover. So this should be absolutely clear when you are solving your question, you know, what you're going to get. So if you just apply formula, you will be always unsure, whether I'm doing it wrong or right. So now, if the Canadian spot rates gains by 4%, which means the pound depreciates by 4%. Now, in this case, as per the interest rate differential theory, or as per the interest rate differential, which the question says that has truly played out in the forward market. So the Canadian dollar should have depreciated by 1.5% for the 6 months, where it has gained by 4%. Okay. So in this case, he will be upset, the company, because they have already taken a forward cover. So had they forecasted the Canadian dollar spot rates after 6 months, they would have not taken a forward cover, because in this case, he's going to lose money. Okay. So the first scenario will be the same. Okay. Because we know that 1 pound is equal to 2.535. And then that means 1 Canadian dollar will be the reciprocal of that. Okay. So we can multiply it with 5 lakhs and to calculate basically how much money he's going to get. So he's getting 1,97,239, which I have explained already. Okay. So the second part, first is the same. Then if the pound, the spot rate was 2.5%, it has depreciated by 4%. That means the pound has depreciated by 4% and the Canadian dollar has appreciated by 4%. So if we take 2.5 into 0.96, so we are factoring in about 4% depreciation in the pound rate. So it will become 2.4. So 1 pound is equal to Canadian dollar 2.4, which was the actual spot rate after 6 months. So had he not covered himself, he would have got 2,08,333 pounds. Because here, what has happened is that the Canadian spot rate has actually gained by 4%. So this would translate in much higher money for this exporter. So if he had not taken a forward cover, he would have got 2,08,333 pounds. So which is 5 lakh Canadian dollar divided by 2.4. Okay. So how we calculated? We took the rate, the spot rate, which was there, at the beginning, which was 2.5 Canadian dollar per pound. So we multiplied by 0.96, assuming that pound is going to appreciate by 4%. Okay. The pound is depreciating by 4%. So which comes to about say 2.4. So then we calculate how much money he will be getting. So he is getting 2,08,333 if he has not taken a hedge. But unfortunately, he has gone for the hedge. So he has taken a forward cover. So he's going to be happy with 1,97,239. So he's going to lose. The loss due to forward cover will be 11,094 pounds. I hope you have followed. Then the last part, if the spot rate remains unchanged. Now, if the spot remains unchanged, what will happen? Will he make a gain or will he make a loss? So just think about, if the interest rate differential is showing that, the pound is going to appreciate. How much? By 3% per annum. Roughly about 1.5% for the 6 months. Fine. So, or, another way we can say the Canadian dollar is going to depreciate by 1.5%. But it has not depreciated. So, which means, again, he's going to make a loss here because he's going to get the 1,97,000 in the first scenario when he has taken the forward cover. But when he takes a forward cover and the remains the same, that means 1 pound is equal to 2.5 Canadian dollar, which is unchanged after 6 months also. So that means it will remain 2.5. So he's going to get 2 lakh pounds. He would have got 2 lakh pounds if he had not taken a forward cover. So the loss due to the forward contract is 2,761. I hope you have followed. If you have followed, please tell me. If you have any query, I'll answer it right away. Okay. So, so the last option was that, it remained unchanged. The spot rate has remained unchanged. That means the Canadian dollar has not declined, though it was, it was destined to decline by 1.5%, the forward rate, because the interest rate differential. So, which means he's going to receive the same amount, when we converted the spot rate at the beginning. So he would have got 2 lakh pounds. But since the forward rate is showing a decline by 1.5%, he's going to receive less. Okay, the Canadian dollar is weakening, say 6 months hence. So he was receiving 1,97,000, but now he's going to receive 2 lakh. He had not taken the cover, he would have got 2 lakh pounds. So he's suffering. Okay, fine. So that covers. Fine. I hope you have followed. Is there any question? Please do ask me at this stage. So we are going to move to say another question. So now we do exercise number 10. Okay. So let's begin. an importer customer of your bank wishes to book a forward contract with your bank on 3rd September for sale to him of Singapore dollars, 5 lakh Singapore dollars to be delivered on 30th October. So basically, this is a customer who is an importer customer. So he wants to book a forward contract with your bank on 3rd of September for sale to him of Singapore 5 lakh, because he needs 5 lakh dollars to make a payment. So he'll buy these, Singapore dollars from the bank. So it will be sale from the point of the bank. So it has to be delivered on 30th of October. So today is 3rd of September. So he needs the money, say 2 months roughly from now. Okay. So this is what the question says. The spot rate on 3rd September are US dollar 49.37 oblique 3800, which means that $1 is equal to so many rupees. So this is a pretty old code. Okay, the question is coming from your study material. So then the USD Singapore is 1.7058 oblique 68. The swap points are also given. Okay. Calculate the rate to be quoted to the importer by assuming an exchange margin of 5 paisa. Okay. Now these are the the swap points which we have mentioned in the middle of the box are given to you. So which means that the rate today of the dollar is 49 points in the month of September is 49.7. The bid rate and the ask rate is 49.38. And similarly, the Singapore dollar USD quotes are given. The swap points for USD rupee, okay, is also given. Okay. So, which is, the spot September is 1300, 300 and 400 October. Okay. So we should focus for the October month. It is 1100 points and 1300 points. Now, you can observe here that this is a reverse, in a reverse fashion it is given. Okay. So reverse connection, which says that it should have been actually rupee dollar quote. So this is a dollar rupee quote. Anyway, no problems. So we should look at, this October month rate. Okay. And USD Singapore is also given as 2 months forward would be the relevant one. Okay, 96 oblique 97. So 1100 oblique 1300 for the dollar, and which is in the right direction. So this is not the reverse, the bid ask, but it is the right thing because the bid is low and ask is more. Similarly, 2 month forward rate is also. So that means the US dollar is showing an appreciation, and similarly the Singapore dollar. Is also in Singapore also the dollar is showing an appreciation. Okay? So let's now solve this question. Since the direct quote of Singapore dollar rupee is not given, okay. So since we had to find out the direct quote of Singapore dollar to versus rupee, so we need to calculate through the cross rates because the banker wants to give him a quote for how much one Singapore dollar will cost to him so that he can book a forward cover. So that is not given. Two rates are given. One is the dollar rupee, another is the dollar Singapore dollar. Okay, so we are more interested to know what is Singapore dollar rupee. So we need to calculate that. So the spot rate on 3rd September are $1 is equal to rupees 49.37 oblique 49.38. So this is the quote which has been given, the spot rate. Okay, on the 3rd of September. Fine. So we know this is a European quote. And how do we know that it's a European quote? Look at the right hand of the quote. If it is, the currency signifies, if it is rupees, then it is a European. If it had been dollar, then it is an American. Okay, fine. If it is any other currency than the American, then it is called the European quote. So now the second quote is also given here. $1 is equal to Singapore dollar 1.7058, 1.7068. Now this is also a European quote. So both the quotes are given European. So I told you, one quote has to be an American to really multiply and get the answer. So we'll just work on it later. Okay. So so these two quotes are given to us. So now we need to first buy dollars. I told you, that what we do is normally think in our mind that we are going to first buy dollar. Okay. As I told you an example, long days about 20 years back or 15 years back, whenever we used to travel outside, like we are traveling in Singapore, okay, so we will be buying dollars in India okay, and going to Singapore and then selling selling dollars and buying Singapore dollars from there. So I repeat that we will buy dollars in India, take those dollars to Singapore, and in Singapore we sell those dollars and buy Singapore currency. So exactly we do the same thing. Okay, we need to buy dollars first by selling our Indian rupees in India, and then go to Singapore and buy Singapore dollars by selling dollars. So this we need to do. So we need to buy dollars first, and then go to Singapore and buy Singapore dollars. So let's begin. So now buy dollars and sell rupee, what we are doing in India. Okay, so 2 months forward rates are given to you. Fine. So the spot rate is $1 is equal to 49.37 and 49.38. So now we are going to buy dollars so at the 2 months forward rate. Okay, so we must first of all calculate the 2 months forward rate because we want to buy dollars. Okay, at the forward rate, because this guy is going to take a forward contract. From 2 months from now. Today he's going to take a forward cover. Okay, at 2 months forward rates. So the spot rate is $1 is equal to 49.37, which is the bid rate, and the ask rate is 49.38. So he's going to add the 2 months swap points to it. So in the question it is given, it is 1100 and 1300. So we'll put a decimal immediately before that, and we are going to simply add them. Okay, because the swap points are in order. So they are increasing order. So that means the US dollar is signifying an increase in 6 months time, in 2 months time from now. So the interbank forward rate would be then 49.4800 and 49.5100. So this is the 2 months interbank rate. Now we know that we have to buy dollars. Okay, so we are going to add the margin. Fine. So, if you remember, in bid, we minus the margin, and ask, we add the margin. So I gave the logic when we explained in the video number 2, the basics. So, and it is given 5 paisa, so we are going to simply add that margin. So the merchant dollar buying rate will be 49.56. So the ask rate is basically the rate which you can buy the dollars in India. Okay, fine. So we'll look at the ask rate. So as a customer point of view, so he's going to the bank and going to, buy the dollars. So he'll get a higher rate, which is 49.56 compared to the bid rate, which is normally lower. When you want to sell, you look at the bid rate. When you want to buy, you look at the ask rate. So merchant buying rate is this. Then let's go to Singapore now. So buy Singapore dollars, and you're going to sell dollars there because now you have dollars with you. Okay, fine. So the spot rate in terms of dollar, $1 is equal to 1.7058 Singapore dollar. So bid and ask rate is given to you. So 2 month swap points is given, so which is 96 and 97. So we'll put the decimal places and put 00, and then simply add them, because here also the dollar is showing appreciation. So the quotes, the swap points are in order, increasing order, so we can add them. So $1 is equal to Singapore dollar 1.7154. Okay, fine. And 1.7165 will be the ask rate. Fine. So now, since the quote is in terms of in dollars, so it is a dollar quote. But we want to buy Singapore dollars. So what we'll do, we'll convert that into Singapore because we want to buy Singapore dollars. Okay, so it should be Singapore dollar. So 1 Singapore dollar will be 1 divided by 1 divided by 1.7165. Okay, so this has been jumbled off. Okay, and 1 divided by 1.74. So we can make a correction here. It should be 1 divided by 1.7165. Okay, so I'll just make it right away. Okay, so that means 1 Singapore dollar would be $5.58258 and 0.58295. Okay, so since we want to buy the Singapore dollar, so the quote should be 0.58295. Okay, fine. So 1 Singapore dollar will cost you that much when you buy it. So the cross rate for Singapore dollar rupee on 30th October would be $1 is equal to 49.56. We have calculated the 2 months forward rate, which is European quote, and 1 Singapore dollar is equal to $0.58295, which is a 2-month forward rate, which is an American quote. Now, both the quotes are in order. So we have the dollar quote with us. We have the Singapore quote with us, 2 months forward. One is European, another is American. So we are set to arrive at the cross rate. So we know that, rupee oblique dollar. So what we'll do is actually we take on the right hand side, we have UP and the dollar. So rupee dollar and then dollar divided by Singapore dollar. So the dollar cancels. So we have rupee upon Singapore dollar. Okay. So which means 1 Singapore dollar is equal to so many rupees. So that means 1 Singapore dollar is equal to 49.56 into 0.58295. So which will give you an answer of 28.8. So that means 1 Singapore dollar is going to be at 28 rupees 89 paisa and 0.8912 paisa. Okay, so this is the quote he will be getting to book his forward cover. So if you look at the question again, the question was given was calculate the rate to be quoted to the importer by assuming an exchange margin of 5 paisa. So it said that, how much will be the rate for the importer. So we have calculated it as, say, 28.89. Okay, fine. So this is the rate. Okay. So this solves our question. I hope you have understood. If you have, okay. If you are not, please ask me a question right now. So the rate to be quoted to the importer will be 1 Singapore dollar is equal to 28.8912. Okay, so this is the rate he will be getting. Okay, if you have any questions, please do ask me. So we are going to move towards yet another question. Okay, so the question is now exercise number 11. A company operating in Japan has today affected sales to an Indian company. The payment being due 3 months from the date of invoice. Okay. So a company operating in Japan has today affected a sales. So this is a Japanese company who has made sales to an Indian company. The payment being due 3 months from the date of invoice. So the Japanese company is going to receive money after 3 months from the Indian company. The invoice amount is 108 lakhs yen. At today's spot rate, it is equivalent to rupees 30 lakhs. Okay, so we can calculate, what is the rate, today's spot rate. Okay, later on we will be doing that. So it is anticipated that the exchange rate will decline by 10% over a 3-month period. So it is anticipated that the exchange rate will decline by 10% over the 3 months period. So that means there is a forecast made by this Japanese company that the exchange rate will decline by 10% over the 3 months time, 3 months period. And in order to protect the yen payments, the importer proposes to take an appropriate action in the foreign exchange market. So when he says that the exchange rate will decline by 10%, okay, so he wants to take a forward cover. The 3 months forward cover, 3-month forward rate is presently quoted at 3.3 yen per rupee. Okay, so he gets a quote that he can convert his money as per 3.3 yen per rupee. So you are required to calculate the expected loss and to show how it can be hedged by a forward cover. Okay, so you are required to calculate the expected loss. So there will be loss anyway, and to show how it can be hedged by a forward cover, right? Because he is expecting the yen to depreciate, so there's going to be a loss. So how he's going to, take a forward cover and cut his losses. So the spot rate which is given, the spot rate we can calculate. So it's 108 yen is invoice, and it is equal to 30 rupees. So 30 lakh rupees. So we can calculate the spot rate comes to 3.6. So today the spot rate is 3.6 yen per rupee. So 3-month forward rate is 3.3. Fine. So definitely the rupee is gaining or the yen is losing ground. Okay. then the anticipated decline in exchange rate is 10%. So expected spot rate after 3 months, this is expected, not the forward rate. So in 3 months, there's a 10%, decline in the exchange rate. So 3.6 minus 10% of 3.6. So you get 0.36. Okay. So that means the rate will be 3.24 yen per rupee. So this is the forecasted rate. Whereas, as for the forward rate was 3.3. So you will be so better off by taking a forward one. So present cost of 108 lakhs yen is equal to 30 lakhs. We know that. So cost after 3 months. So, he's going to, if it was a present cost, how much he was getting? 30 lakhs. So cost after 3 months will be, 108 divided by 3.24. So the cost will be, because he is going to, his cost will be 33.33 lakhs if he, as if the exchange rate declined by 10%. So the cost is going to go up from 30 lakhs to 33.33 lakhs. Now, the expected loss is going to be 3.33 lakhs. We know that. Okay, by simply calculation. So because it is 30, so his cost is not going to be 33.33. Okay, so he's going to incur more 3.3 lakhs. Fine. So if the expected exchange rate risk is hedged by a forward cover, then cost after 3 months will be 108 lakhs divided by 3.3. Okay, so which is 32.73 lakhs. So expected loss will be then 2.73. So that means if he takes a forward cover, he's going to suffer 2.73 lakhs. If he's not going to take a forward cover, then the expected exchange loss which he calculated was 3.3. So that means he should go for a forward cover. So hence taking a forward contract is suggested, as the loss is going to get reduced because of that. Okay. Fine. So let's move to yet another question. This question was simple. Okay. So it doesn't require much of an explanation. So let's go to exercise number 12. Okay. So there's a company called ABC. They have taken a 6 months loan from their foreign collaborators. So there's a company which has taken a 6 months loan from their foreign collaborators for US dollar 2 million. So that means this is a company which has taken this company ABC have taken a 6 months loan from their foreign collaborators for US dollar 2 millions. Okay, fine. So interest payable on maturity is at LIBOR plus 1.0%. And the current 6 month LIBOR is 2%. So LIBOR is basically interbank offered rate. So they have taken a loan at LIBOR plus 1%, and today's LIBOR is 3%. So that means the interest rate will be 3% if we add the LIBOR to it. So inquiries regarding exchange rate with their bank elicit the following information. The spot rate today is $1 is equal to 48.5275. Again, this is an very old quote. Okay, so spot rate of US dollar at that time was 48.5275. Now the 6 months forward rate which has been given is 48.4575. Now note the forward quote as well as the spot quote. What is happening to dollar? Dollar is actually depreciating. Unusual, because the dollar normally appreciates. Okay, so 6 months forward rate which they get from the banker is 48.45, which signifies that the dollar is going to weaken against the Indian rupee in 6 months' time. Okay, what would be their total commitment in rupees if they enter into a forward contract? Okay, so we need to calculate what will be their total commitment in rupees if they enter into a forward contract. Now, this company has taken a loan and the rate of interest is 3%. So that means they're going to, pay off the loan of 2 plus the interest rate. Okay, so let's work out. What will you advise them to do so? Explain, give reasons. So what would be their total commitment in rupees if they enter into a forward contract? And will you advise them to do so? Explain, giving reasons. Okay. So firstly, the interest rate is calculated at 3%, which is LIBOR plus 2%. So that means the company is going to pay a 3% interest on the loan what they have taken on 2 million for 6 months. So we know that a loan is for 2 million, or which is 20 lakh rupees. So we multiplied by 3 divided by 100 into which is 3%, and the loan is for 6 months. Okay, so we just calculate the interest will be 30,000. So the interest is calculated at 3% per annum, and it is 6 months this thing. So we just multiplied with 3, which is the interest rate, and multiplied by 6, which is the months. So we get the interest as 30,000 US dollars. So from the forward points quoted, it is seen that the second figure is less than the first. This means the currency is quoted at discount. So I told you at the beginning that the dollar is showing a decline in the next 6 months' time. The value of the total commitment in rupees will be then 20 lakhs 30,000 multiplied by the forward rate. Okay, so we get a figure of if we multiply this with the so let me just check. Okay, it's 30,000. Okay, multiplied by 48.4575. So that means it is going to be 9 crore 83 lakhs 68,725. So that means he is going to pay after 6 months. The amount will be, in terms of Indian rupees, will be 9 crores 83 lakhs 68,725. So if he uses the forward cover, okay, then he has to pay 9 crore 83 lakhs 68,000. Okay, so since the dollar is showing a decline, so he's going to get a benefit of that. Okay, fine. So it seems that the forward rate that the market expectation is the dollar will depreciate. Okay, so as per the question, the dollar is depreciating. So the forward rates are showing that expectation in the rate itself. If the firm's own expectation is that the dollar will depreciate more than what the bank has quoted, now because the dollar is depreciating, so you may expect a little more depreciation going forward, say in 3 months' time. So in that scenario, it may not be worthwhile not to go for a forward cover and keep the exposure unhedged or open. So if the customer's view or the client's view is that the dollar is going to further depreciate because it is already showing a decline as per the forward rate and the spot rate. So the customer of the bank may think that it may further decline. So in that case, you should not go for a forward cover. If the firm has no specific view regarding the future dollar price movement, it should be better to cover the exposure. Now, if he has not, done his exercise and he thinks that, he doesn't have any view, then it is always better to take a hedge himself. Okay, so don't leave any, foreign currency risk, uncovered. So that is a normal, kind of a thing which a company does. Okay, so most of the companies would like to cover their risk. Okay, except for some specific companies which have a natural hedging because they are exporting and importing both. So normally all the companies, they hedge themselves, the foreign currency. They will never leave any exposure unhedged. So this would freeze the total commitment and insulate the firm from undue market fluctuations. In other words, it will be advisable to cut the losses at this point of time. So basically, it is always advisable for the companies to, go for forward cover. Okay. So, but, again, we should always remember that given the interest rate differential and inflation rates between India and USA, we all know that the differentials in India and USA, it is unwise to expect continuous depreciation of dollar. Because, the interest rates in US is quite low as compared to India. Even the inflation is quite low as compared to India. So normally the US dollar will always appreciate. In a long term, it is going to appreciate. Okay, fine. So he should not expect this quite often. So because of some particular reason, it's showing a forward rate, is showing a depreciation of USA, it doesn't mean that USA dollar will depreciate for a long term. So the US dollar is a stronger currency than the Indian rupee based on the past trends, and it will be advisable to cover the exposure. So I told you, at one time that, at one time, $1 was equal to 1 rupee. And today when we say it's close to about 75 or 74 bucks. So over the years, the dollar has appreciated over Indian rupee, and the rough, kind of a rough calculation is about 4 to 5% kind of an appreciation per annum, which happens. So that normally reflects the interest rate differential between India and USA. So now we go to say yet another question, exercise number 13. Okay. So this is another exercise which we'll be doing. So which is exercise number 13. An Indian importer has to settle an import bill for $1,30,000. The exporter has given the Indian exporter two options. So this is an Indian importer. He has to settle an import bill for $1,30,000. The exporter has given Indian exporter two options. Okay, so there are two options given to this importer. Pay immediately without any interest rates. So pay immediately without any interest charges. First option. Second, pay after 3 months with interest at 5% per annum. So these are two options. Pay immediately without any interest. So this is the first option. Pay after 3 months with interest rate at 5% per annum. So this is the option given by the exporter to the importer. And he has to pay how much? $1,30,000. The importer's bank charges 15% per annum on overdrafts. So if he's going to pay immediately, okay. So, and the other option is that he's going to pay after 3 months. So that means if you just see that your company has to take a overdraft facility, then they will have to pay 15% per annum. The exchange rates in markets are as follows. Spot rate is 48.35, which is the bid rate, and 48.36, which is the ask rate. Okay. 3 month forward rates are also given to you, which is 48.81 and 48.83. Okay, so the spot rate and the forward rates are also given, and it also signifies that the dollar is going to appreciate. The importer seeks your advice. Give your advice. So the question is, the importer is seeking your advice. So fine. So let's understand, what should he do? If the importer pays now, he will have to buy US dollars in the spot market by availing an overdraft facility. Okay. Accordingly, the outflow under this option will be amount required to purchase $1,30,000 into multiplied by the ask rate here, okay, which is 48.36. So that means the amount will be 62,86,800 rupees. Okay. So we are going to add interest for 3 months, 15% per annum. So which calculated on 15% on 62,86,800 works out to be, for 3 months, it's worked out to be 2,35,755. Right. So he's going to add this. So total outflow will be 65,22,000. So 55. So which is basically the principal amount, which is 62,86,000, which we have calculated by using the ask rate. If you look at the spot rate in the question, it is given 48.35 and 48.36. So this ask rate has been used to calculate for purchasing Indian rupee. Okay. So he has to make the payment. Okay. So that means the total outflow, because he has to pay in dollars, so he is going to shell out 62,86,800, okay, multiplied by say 15% rate of interest for 3 months. So total outflow will be 65,22,555. So this is the total outflow which is going to happen on account of this transaction. So if the importer makes the payment after 3 months, then he will have to pay interest for 3 months at the rate of 5%. So he has to make, if he is going to make a payment after 3 months, he is going to pay interest to the exporter. Okay. So that means accordingly, he has to buy dollars in the forward market. The outflow under this option will be as follows. So the amount of bill is $1,30,000. So add interest for 3 months, which will be $1,625. So, and the total dollar outflow will be 1,31,625. Now here the exporter is saying, pay me after 3 months. Okay. But pay me 5% rate of interest. So now instead of paying $1,30,000, you have to pay $1,31,625 along with interest. But in this case, we are going to use the forward rates. Okay. So the amount to be paid in Indian rupee after 3 months under the forward purchase contract would be 64 lakhs 27,249. How we have worked out the total dollars payment, which is including interest, 1,31,625 multiplied by the forward rate, ask rate. Okay, so that means here the outflow is 64 lakhs 27,249. When we worked out the first option, it was coming to 65 lakhs 22,000. So that means the option number 2 is better. That means he should go for a forward rate, okay, a forward cover, and pay the interest. So since the outflow of cash is least in option number 2, it should be opted for. So look at the 3 months forward rate here. When we calculated this 64 lakhs 27,000, we multiplied by 48.3, which is the ask rate. Okay, so because he being an importer, he has to purchase the dollar. So when you go to the bank, you look for the higher ask rate. Okay, and the bid rate is lower. When you're going to sell, you have to pay this. When you want to buy as an importer, you have to look at this rate. So we multiplied by 48.83. So he got his total outflow. So here we find that the outflow is less in case he goes for a forward cover. He takes a forward contract and pays the interest to the importer at 5%, and he takes a forward cover. So after 3 months, the forward purchase contract will be this much. So in both the options, we find option number 2 is better. Okay. So now let's now cover, exercise number 14. So there are a lot of questions which we are doing today. They're all from your study material. So I hope it is helping you out. Okay, fine. And you're understanding these questions. So let's go to, exercise number 14. So this would be our last question for this topic. And then we'll move to the futures, which is, more interesting and very, very, so I would say that, just be ready for some excitement, which will be, entering by understanding the futures. We will be going to the stock exchange also there. Okay. So there's a company called Gibraltar Limited has imported 5,000 bottles of shampoo at a landed cost in Mumbai of 20 each. So this company has name is Gibraltar Limited. They have imported 5,000 bottles of shampoo at a landed cost in Mumbai of $20 each. The company has a choice for paying for the goods immediately or in 3 months. So almost similar question of what we have done. So here I'll ask you to just solve it yourself, okay? And then I'll show you the answer. I'll give you a couple of minutes, this thing, and you can solve it. The company has choice for paying for the goods immediately or in 3 months' time. It has a clean overdraft limit where 14% per annum rate of interest is charged. Okay. So I hope all the slides are with you. So you can just look at the slides and you can try to solve this question yourself, though the answers are with you. So how much money the company has to pay? 5,000 multiplied by $20 each. The company has a choice for paying the goods immediately or in 3 months' time. It has a clean overdraft facility at 14%. Okay. Calculate which of the following method would be cheaper to this company, Gibraltar Limited. Pay in 3 months' time with interest, okay, at the rate of 10%, and cover the risk through forward for 3 months, okay. Settle now at the current spot rate and pay interest of the overdraft for 3 months. So you can, pay immediately and, pay a 3 months overdraft interest. Okay. So the rates are as follows. Mumbai rupee dollar spot rate is 60.25, 60.55, and 3 month swap rates are 35.25. So look at the swap points which are, decreasing. Okay. So remember, so that means it signifies that the dollar will depreciate in the 3 months' time. Okay, fine. So that's a kind of a thing you should take care that the swap points are not increasing order; it is decreasing order. Okay, so now just do it yourself. I'll give you a few 1 minute to understand and solve it. I'll just So I'll just, in the meantime, I'll just going to, shuffle across the question so that you can, if you don't have the question with you, you can just solve it yourself. So, okay, Sumit, you're getting solving these exercises by hand is much more effective. So if you want, I can just do it on the board. So maybe, I'll solve this question on the board so that you can see it, okay? Fine. Okay, I think you're able to see the board. So this company is, so we will start. So we know that, let's go for option number 1. So you can also solve along with me, okay, so that we can. So repayment in 3 months' time. So option number 1 is basically repayment in 3 months' time. So which means that the question says that the company has a 3 months' time, okay, payment in 3 months' time with interest rate of 10%, okay. So option number 1, which is repayment in 3 months' time. So this is the option number 1. So the total amount is, if we multiply the shampoo number of bottles with the dollar price, it's 20, so it comes to $1 lakh. Okay. So this is $1 lakh to be paid in 3 months' time. Fine. So in this case, we have to add the interest. So it will be 1 plus 10% rate of interest divided by 4, because this is going to be 4 months. Okay. So which we get as 1,02,000. So it will be $1,02,500. So that means if he has to pay 1 lakh after 3 months, he has to pay 10% rate of interest. So the total amount he has to pay is $1,02,500 after 3 months. Fine. Now we know that the spot rate which is given. So I'll use a better pen. So the spot rate given to us is rupee 60.25, 60.55. So this is the spot rate. Now the 3 months swap points are given to us. Okay. So which is 35 and 25. So which means you can put here. So this will be rupees 59. So here will be minusing because the dollar is depreciating here. Okay. So 50.9 because the swap points are showing a declining trend. So that means the dollar is going to have a lower rate going forward compared to today. So this is going to be 60.30. So this is the rate which we expect, say after 3 months time. So the 3 months quote would be bid rate of 59.90 and the ask rate of 60.30. So that means this will become the relevant quote because he has to make a payment. Fine. So which will be, 1,02,500, okay, multiplied by 60.30. So this is going to be his total outflow, which is going to be rupees 61,80,750. So this is going to be total outflow on account of rupee if he goes for option number 1. The option number 1 says that repayment in 3 months time along with 10% rate of interest. So it is for 3 months. So that means after 3 months, he is supposed to pay $1,02,500. So if you look at the spot rate today and we calculate the forward rate, so the spot rate is 60.25, okay, and the swap rates are showing that there is the dollar is going to depreciate. So we are going to minus these off because the bid rate, the swap points and ask swap rates are declining trend. So we are going to minus it. So the rupee is 59.90 and 60.30. So since he is going to buy the dollars, so the rate is 60.30 for him, which is the ask rate. So 1,02,500, which is his total outflow in terms of dollars multiplied by the rate 60.30, that is rupees 60.30 per dollar. So the total outflow will be 61,80,750. So we can just write here. So option number 1. Option number 1, the outflow is rupees 61,80,750 rupees. Okay, fine. So I can just run this off. So let's go to the option number 2 now. So where he goes for an overdraft. Okay. So which means that he's going to pay immediately. Okay. So we know it is $1 lakh he's supposed to make a payment for. So here he doesn't have to pay any interest as such to the exporter. Okay. 1 lakh multiplied by the current spot rate, okay, which is given as rupees 60.55. So this is the current rate, So he has to pay 60.55, which is, rupees 60 lakhs 55,000. Fine. But since he has paid upfront, okay, so he is going to actually pay interest, which is given as 14%. Okay, so which will be, that means it has to be 60 lakhs 50,000 multiplied by 14% rate of interest. Okay, 14%. So divided by 4 because it is after 3 months. So then the figure will be 14% rate of interest. So we can just calculate this and write it correctly. So it is going to be 0.14 divided by 4. Okay. So which is rupees 2,11,925. Okay. So just let me just do a calculation to check that. 60,55,000 into 0.4 divided by 4. So this is 2,11,975. So this is, if he pays it immediately, okay, then yes, he's using the spot rate, which is 60.55, the ask rate. So this much amount he has to pay immediately. But for making this payment, he has to take an overdraft facility. On that, he's going to pay 2,11,925 as the total interest. So the total outflow will be then 62,66,925. So this is his. So this is option number 2. Okay. So which I can say option 2. Okay. So he pays this. So now I write it here. Option number 2, 62,66,925. Okay. So if you find the option number 2 is more costly, okay, compared to option number 1. So in this case, you should go for taking a forward cover. And why so? The logic is very simple, because the dollar is depreciating compared to the Indian rupee. So if he uses the first one, he is going to pay less. But after say 3 months, so he is going to because the dollar is going to depreciate, is going to pay less. Today the dollar is stronger, so it is working out to be more. Okay. So option number 2 was immediate payment. So the dollar is trading today at 60.55, whereas if you find it was less than say 60 point something, lower than this rate. Okay, fine. So option number 2 will be costlier for him if he uses the current rates, because the dollar is stronger today compared to what it is going to be in the forward rate. So you're going to get, you can just apply the logic. Normally you will find this option being costlier compared to the first one, because the dollars you will find are declining going forward. Of course, then you have to see whether the interest rate, how it is impacting your outflows. So option number 1 should be preferred, as it has a lower outflow. Okay, fine. So what I'll do is that I'll go back to the screen now. I hope it's okay now. Sumit, have you followed? You wanted, following by hand, so I've done it. So if whenever you want that I should do it on a board, please let me know. You find if that is a better mode. But then I always move slow, and my slides are not coming. All the things are not coming at one go. So that's why I use both the mechanism to teach. Okay. So now let's see this question again. Okay. So exercise number 14. This was the question we just immediately solved. Okay. So this look at these the difference between the spot rate and the forward rate. The 3 points signifying a decline in dollar rate. So so this was our first solution. Option number 1, payment in 3 months time, $1 lakh. The dollar term, in dollar terms, it will go to $1,02,500 because it carries a 10% rate of interest. So the spot rate is 60.25 and 3 months swap rate is 35.35. So that means the forward rates are going to be is going to be 59 point this, and then 3 months outright forward rate is 59.90 and 60.3. So that means we are going to multiply it by $1 lakh, 1,02,500 into 60.3. So that means the total outgo will be 61,80,750. Okay. So this is in the option number 1. So the total outflow in the option number 1 is 61,80,750. Basically, here he is doing a payment in 3 months' time along with the interest. Okay, using the forward rate. Now, this is the second scenario where he takes an overdraft, okay, and he pays at the spot rate. The spot rate is given as 60.55, so $1 lakh multiplied by 60. So total outflow will be 60 lakhs 55,000, and then we add interest to it, which is 14%, which comes to 2,11,925. So the total outflow will be 62,66,925. Okay. So option number one was much better. Okay, where the outflow was much lower. So if you look at the option number one, it was 61,80,750, and here the outflow is 62,66,925. Okay, so option number one should be preferred. Okay, so so here we are through with this exercise. So we will move on to now the second chapter, which is second chapter for the day. So what we'll be covering today is currency futures market. I hope the screen is visible to you all. So we are going to talk about futures market. So this is a very, very interesting topic, right? So I'll just adjust my video. So this is a very interesting topic, as I told you. I hope you can see the screen now. So I'm just going to put the relevant video now, the slides on the screen, so that you can see it. So this is I mean we'll just do it for 5-10 minutes. We'll have a break after that. But we have the currency future market, which is the most interesting topic. So we are entering into futures and options now, which is going to excite you a lot, because we will be taking the help of a stock exchange to take our covers, to risk ourselves, to cover the risk. Okay, and people always speculate in the stock exchanges to make quick money, whether in the stock market or in the foreign currency market. So we are going to learn a lot of things in the futures and options market. Though you should pay a lot of attention and focus, because there are a lot of small things and some small basics which you have to learn. Okay, so please do pay utmost attention. It will really be helpful for you to solve your questions in your study material, as well as to understand how these markets function. Okay, so let's begin. So now, in every business is subject to risk of unforeseeable changes in business environment. So we know that every business is subject to the risk of unforeseeable changes in the business environment. Volatility in exchange rate reflects or affects our business growth and can be significant, because we know that there is a lot of volatility which is happening in the exchange rate, which can affect your business. Okay, which can affect the growth of your business. If you are an exporter, importer, or have a foreign currency loan, you are directly exposed to exchange rate fluctuations. It is possible to mitigate these risks by using suitable hedging instruments, and futures is one kind of such instrument. So far, what we have covered is forward contracts. Now we are entering into the arena of futures and options. So the first part, which I'm going to cover today, and we'll be doing some couple of questions today itself, will cover the futures. Okay, so it is possible to mitigate these risks by using suitable hedging instruments. Okay, now let's understand a little bit about currency futures in India. Fine. In India, the stock exchange provides foreign currency exchange risk management. The contracts are available today in India are future contracts in US dollar INR pair, Euro INR pair, pound INR pair and Japanese INR pair. So these are the four, contracts in futures which are available in India. Of course, the question you can get, even any pair. Okay, but you must understand the logic so that you can solve any kind of question which comes to you. So in India, we have four pairs currently, USD INR, Euro INR, Pound INR, and Japanese INR in the futures market. Maximum 12 monthly contracts. So there are 12 monthly contracts which are there in India. Every time, whenever you go to the market, you will find, now today we are in January, so we'll have January to December 12 monthly contracts which are available. Depending upon which month you are looking for. Suppose you're going to get your money in, say, March, so you are going to focus on the March contract. Because here you enter into contracts with someone, okay, to take either to hedge or to speculate. So if you are going to receive money or you're going to make a payment in, say, April, then the relevant month will be the April month. So there are 12 months contract which are available. Okay, depending upon your need, you go to that particular month and take a bet on that. So one more thing, here is very important is that in the forward market, you go to the bank and book your dollars and you get dollars. But in futures market, you don't get dollars. You will be either making a cash profit or a cash loss. Okay? And how it helps, let's understand that through an example. So futures are cash settled. There is no physical delivery happening in India. Okay? So then you have to go to the bank to take your dollars or your euros or Japanese yen or whatever currency you're looking for, whether you're making a payment or you're going to receive. So you go to them and look at the spot rates that time. Okay. So let's understand how you do a hedge without really understanding all the nitty-gritty of futures market and all the kinds of specifications. Let's begin with an example. Okay. And while I explain the example, I'm going to tell you a little bit specs also. And then we are going to understand the specifications, these contract specifications. Soon after my example is over, and then you will able to appreciate about these all these specifications. You will be better understand. If I do the specification now and do the example later, then I always thought that it's always better to explain through an example all the specifications. So example for hedging. Okay. Okay. So, example of hedging using currency futures for import. So, this is an example of hedging using currency futures for import. So, we are believing that you are an importer. Okay, you are going to make a payment abroad, and instead of using a forward contract, you are hedging using currency futures. Okay. So, X is an importer, right? XYZ is an importer. On 15th October 2020, XYZ Limited wished to book its forward remittance, its outward remittance for 25th November 2020 worth $1 lakh. So today is 15th of October 2020, and XY Limited wished to book its outward remittance for 25th November. So that means he has to make a payment on 25th of November, which is amounting to $1 lakh. So remember, today is 15th October, and he has to make a payment as an importer, which is $1 lakh. Now, dollar future is currently trading at 73.50. So this is the November month. So I told you there are 12 monthly contracts. So since you are going to make a payment in the month of November, so you're going to go to November months, okay, in the stock exchange and look at what the dollar future is trading at. So dollar future is currently trading at 73.50. So in bracket, LTP stands for last traded price, okay, which is the price which you open the screen, you find that it's trading at 73.5 because the price can change every now and then. So you went to the market, you find that for the expiry 25th November, the future is trading at 73.50. Okay. So now in the futures market, the contract size is $1,000. That means if you have $1,000 to make a payment, then you have to enter into one contract. But since here it is $1 lakh and each contract is for $1,000, so that means you have to buy or sell 100 contracts. Okay. So here the problem is because it is standardized, futures markets are standardized. So if you have $1,500, then you can either underhedge or overhedge, because either you have to buy or sell 2 contracts or 1 contract. If you buy or sell 1 contract, you are underhedging because your actual exposure is $1,500. Fine. So in the standards, because the future is having standardized, standards here, the standard sets in terms of lots. So either you are overhedged or underhedged. But in this case, since you have $1 lakh US, so you are absolutely properly hedging yourself by looking at 100 contracts. Okay. So what will you be doing? You will be buying currency futures. No, you can either sell currency futures or you can buy. Why we choose to buy currency futures? Now here, whatever your position is in your real market, you are an importer. Okay, you are going to make a payment in terms of dollars, but you don't have dollars. So you are short of dollars now. Okay, so you have to take a long position in dollars. So remember, this is very important. Because you are an importer, you are going to make a payment in dollars after, say, on 25th of November. You don't have dollar today as an importer. So that means you don't have dollar, you are short of dollar. So you will take a long position. A long position would be a buy position. Okay. So you will buy currency futures. So we can say, you buy currency futures, you take a long position, or you're bullish in dollars. Okay, so these are one and the same thing. So you buy currency futures. Now you just take the opposite position, whatever position you have as an either importer or exporter. So as an importer, you are short in dollars, so you're going to take long in dollars. Okay, so you buy currency futures at 73.50. Okay. Now, when you buy currency futures, that means you buy a contract. Okay, you buy a contract in the futures market that you are going to buy the dollar at 73.50 at this rate, and you can exercise your this contract anytime before 25th of November 2020. So you get a right to buy the dollars at 73.50. So this gives you a right to buy the dollars at 73.50. Now, if you buy it, if the dollar goes up, you stand to make money. But okay, we'll discuss that shortly. So here, when you enter into a contract, you pay 3% margin. So the stock exchange is going to charge 3% margin from you as well as the person who has sold the currency futures. So there is a 3% margin currently in India, which is being charged for both to the buyer as the seller. So you have to pay 2,20,500 as a margin. Okay. Now, so LTP was the last trading price. Okay. Now the spot rate on 15th of October, when this guy was looking at the stock exchange, the spot rate was 73.37. So that means its rate is 73.50 because the dollar is going to appreciate going forward, and it is correctly reflected in the stock exchange also because the rate is 73.37 the spot rate, whereas the future rate is 73.5 1 month from now. Now let's have a scenario. Either the dollar will go up or the dollar will go down. So after the month end is over, that means 25th of November, okay, the expiry date. Suppose you wait till expiry, assuming the case one, the dollar has gone up to 75. Now the RBI gives a reference rate, okay, and the stock exchange uses this rate to settle the trade, okay, and this is normally equal to the spot rate, normally very close to the spot rate in the market. So assume US dollar INR rate is 75, which is the RBI reference rate. So that means since you have taken a buy position and the dollar has gone up to 75. So you enter into a contract to buy dollars at 73.50 from someone, but the rate has gone up to 75. So in that case, you are buying something which is today at 75, and the rate fixed by you was 73.5. So you're making a profit. Okay, how much profit? 1,20,000. So you are bullish in dollars, and dollar has gone up. So you're actually standing to gain by taking a long position in dollars. Okay, so you're gaining 1,20,000. So the margin will get released at the month end. Whatever money you pay as a margin, that will be taken off. Okay, and you will get a 1,20,000 rupees profit also. Okay, so now what happens? The importer has to pay 75 lakh rupees on 25th November at the spot rate. Now, the month end is over, 25th November has come, the importer will go to the bank, and the rate assuming is 75 rupees spot rate. So the importer has to pay a payment of 75 lakhs. So this is the transaction which is happening, outside the stock exchange. Okay, fine. But his net outflow will be how much? He pays 75 lakhs, okay, the actual transaction, but he gets 1,20,000 rupees as profit. So his total outflow will be 73,50,000. Fine. So he is hedged and fixed his payment of 73.50. So please understand that he has taken a long position in the futures market at 73.50, which means he gets a right to buy the dollar at 73.50 up to 25th of November, okay, 2020. But what happens is the dollar goes to 75, so he makes a profit. Because he was bullish on dollar, it went up to 75, so he has a right to buy at 73.50 from someone, so the person will not actually give him a dollar, he'll give him the profit. Okay, so he will give a profit of 1 rupee 50 paisa, which will be multiplied by $1,00,000. You will get 1,50,000 from the stock exchange. Okay, since you are making money, okay, and you will be getting this money along with the margin which you pay to the stock exchange, so the margin will get released. But now we are on 25th November, so importer has to make a payment. Okay, he goes to the bank, and the bank says today the rate is 75, so you have $1,00,000 to pay, so you pay me 75 lakh rupees so that I can remit the money to the importer. So he does it. But since he has got 1,50,000 as a gain from the stock market, so his total outflow on account of this transaction will be 73,40,000. So he is hedged. That means he is paying 73.50 by taking the two transactions together. One outside the stock exchange, another through the stock exchange. Okay. Now this is the case when he makes a gain. So let's say that the case 2, where on 20th November the dollar comes to 72.50. Since he was bullish in dollar, but the dollar has come down, so he makes a loss. How much? 1 rupee loss per dollar multiplied by $1,00,000. So which means he has lost $1,00,000, and he has to make that payment to the stock exchange, and the stock exchange will make the payment to the other guy who has won the money from his gain, but you are lost. So the margin will get released immediately. You make a payment of 1 lakh, the margin gets released. So now importer, when he is making a payment, he pays only 72,50,000 because the spot rate today is 72.5. So he goes to the bank and says, okay, I have to make a payment. How much I have to make? He says, okay, you have to pay 72,50,000. But what happens since he has lost 1 lakh rupees in the stock exchange? So we add to it, so the net outflow would be, that means he's hedged. So whatever happens to the exchange rate, he is going to pay, his total outflow will be 73.50 per dollar. Now in this case, we can see when the dollar appreciated, he was making a gain. Okay, when the dollar depreciated, he was making a loss. But in both cases, the overall outflow was to the tune of 73.50. So in this case, what happens is he's not taking the advantage when the rate drops. As an importer, you would have been very happy if you have not taken a futures contract, you would be paying 70. So that's why option contracts come. So we will understand that later. Okay, there he can walk out of the contract if the rate drops. Fine. So we'll understand that in our next class. So in this case, he pays. His total overall commitment is only 72 point. Yeah, in currency futures also expires on last Thursday. Yes. So no, we'll talk about that. Okay. So the stock exchange, the futures, expires on the last Thursday of the month. Fine. You're right for the stock exchange for the stocks, but not for the futures. So we are going to understand those specs, specifications little later. Okay. Just be patient with that. Okay. So as I was telling you that here he is hedged with 73.5. So this is at 20%. So so now we are going to do an example on hedging using currency futures for export. Fine. Just before we do into that, I am just going to take you to the stock exchange to show you how it happens. Okay. If we can go to the stock exchange, it will be very good. So let me see if I can take you to the stock exchange. So we go to currency market. So we go to place order. Okay. So if you I've just opened the stock market currency futures place. Okay. So we are currently using the ICAI window to explain how the currency market functions. So you have the National Stock Exchange and the Bombay Stock Exchange, and this is a future product. So action is that you can either buy futures or you can sell futures. So the underlying pair would be, say, I use USD INR pair. Okay, fine. So then I have to select a contract here. So first I have to choose the National Stock Exchange or any exchange, and I say select a contract. Okay, so you have to select the action also at the same time. So I select buy and National Stock Exchange. Okay, so this is you look at this thing. So because there are 12 contracts. So this is USD and the spot rate is 73 rupees 1 paisa as of today at the moment. And this is a future currency contract in pair USD INR. So 27th January 2021, lot size is 1000. Last traded price is 73.20. Select the contract. So you can use either if you are going to get your money in January, choose the 27th this expiry period contract, or February. So you find the rate for all the months are open, all available. So it goes right up to 12 months. Okay. So you get quotes for in terms of one lot size is 1000, and the last traded price per dollar is 73.20, then 73.40. And if you look at the 12-month last month, which is going to be December 2021, so the rate is going down to 76. So as you can see, the dollar is appreciating over the 73 to 76. So there are 12 contract which are always open. Okay, fine. So you can just choose a contract. Suppose if you are, you have to select a contract. Suppose you're going to get your money, say in the month of April. So you choose April contract. So now you will be contract detail will come here. So suppose you want to buy, say 100 contracts because your exposure is say $1 lakh. So then you can just, give the rate here. Okay. So April rate is how much? April rate is 74.02, which is the last trading price. So I can just put a price 74.05 or whatever I can give, and I can say submit. So now my order can be booked. Okay, so I have taken a buy decision through National Stock Exchange. Contract details are April. Quantity is 100, so $1 lakh US. Limit price is 74 I put. Okay, and 1,000. Estimated order value is 74 lakhs 5,000. Okay, then you say add margin. So it is going to, as soon as I say proceed, it will go for adding. So I won't do that because this is my actual trading account. So I'll just log out and go back to the screen and explain that. So coming back to, so we are back to our question. So I am now, so will that 1 lakh rupees amount not deducted from the margin? Okay. Fine, I'll explain that. Okay. So then, can you just focus on that? So I'm going to explain the same thing which you have asked here. So example on hedging using currency futures for export. Okay. So you are an exporter, fine. You are going to receive dollars, isn't it? So you are long on dollars. So that means you should take a short position in the futures market. So let's do that. So XYZ is an exporter, right? So on 15th October 2020, XYZ Limited wishes to book its inward remittance for 25th of November. So he's going to get $1 lakh on 25th of November. Okay. So he goes to the stock exchange. He finds that the dollar future is currently trading at 73.65. So you look at the November expiring month, okay, which is going to expire on 25th of November, and the November coincides with actual payment received. Okay, so he's an exporter, he's going to receive on 25th of November, and the expiry is also happening on 25th of November. Okay, fine. So he looks at the rate of the dollar, which is 73.65. So number of contracts will be again 100. Okay, so now what he's going to do? He's going to sell the currency futures. So that means he's going to enter into a contract to sell the dollars at 73.65. Okay. So by doing so, he's going to hedge himself at 73.65. So he gets a contract. He enters into a contract with someone that he's going to sell the dollar at 73. Whatever happens to the dollar, he's going to sell at 73.65. Now, the moment he enters, he has to pay a margin of 3%, which is 2,20,950, which is 73,65,000. 3% of 73,65,000. Now the spot rate was 73 point, which is at the bottom of the screen. The spot rate that day was 73.37, and the future rate is 73.65. Okay. So that is just to explain. Okay. Now what happens? Now the month end happens because he has to wait for the month end because he is going to receive his payment on 25th of November. So scenario number one, where the dollar goes down. Okay, he's an exporter, so he doesn't like that. But since he has actually, gone and sold futures, he's going to make money. Okay, so he has sold at 73.65, so he's going to get a cash profit. Okay, so he has taken an opposite position. He was actually, long in dollars because of export. He's going to get dollars from someone, but he has actually sold, dollars. So he's taken a short position in dollars. So he will gain because he has sold to someone at 73.65. Okay, but the rate has gone up to 72.15. So other guy is going to take, at 73.65. Today, the dollar is what, 72.15 after 1 month. but he's actually got a right to sell at 73.65, so he's going to make a gain. How much? 1,20,000. So that is, 1 rupee 50 paisa gain multiplied by $1 lakh. So the margin will get released, okay, and he's going to also get 1,50,000 rupees, okay. So exporter will get now. So now he goes to the market. He goes to the spot rate is 72.15, okay. So he will get 72,15,000. When he goes to the bank says the rate is 72.15. So he goes and goes with $1 lakh. So bank will give him 72,15,000 rupees. Okay, fine, because the dollar has come down. But he's going to get 1,50,000 as a gain from the stock exchange. So his total inflow or net receipt will be 73,65,000, the rate at which he booked his contract originally. So he's completely hedged at 70. Whatever happens to the dollar, he is going to get his money at 73.65. So this is the case number one. Now, case number two, if the dollar goes up. If the dollar goes up, since he has sold at 73, he's going to make a loss. So if the loss is going to be, 1 rupee 50 paisa, so overall loss is 1,50,000. So margin will get released, and exporter will get 75,50,000 in the spot market. When he goes to the bank with $1 lakh, the bank will give him 75,15,000, but he has suffered a loss of 1,50,000 from the stock exchange. So his total outflow will be 73.65. So he's hedged. So whatever happens to the dollar, whether it goes up or down, okay, his net receipt will be 70. If it goes up, fine, he's going to suffer a loss in the stock market, but a gain in the spot market. So that will get neutralized. So his total outflow will be 73 lakhs. But in the first scenario, if the rate goes down, he makes profit in the stock exchange, but makes a loss in the spot market. So a profit of 1,50,000 and a loss in the real market. So overall exposure will be limited to 73.65. So he has hedged himself at 73. I hope you have understood. Okay, fine. So now let's talk about, because speculation also happens in the market. You may not be an importer, you may not be an exporter, but you are just a speculator. You are making money only by taking, a call, whether, the dollar, euro, Japanese yen, or pound will go up or go down. So you want to make money, as you can make money in the stock market. So by, on stocks. So the similar question, you can always, bet on any currency. Right? If you expect the dollar to go up, you will take a long position. If you expect the dollar to go down, you will take a short position. Similarly for other currencies. So let's understand this. You are a speculator. So X is a speculator. He is bullish on dollar. Okay. He is bullish on dollar. On 15th October 2020, X speculates for 25th of November 2020, contract worth $1 lakh. So he's a bullish guy. Okay. Right now it is 15th of October. And he wants to take a 1 month call on dollar. He expects the dollar to go up in 1 month's time from now onwards. Okay, so currently the dollar is trading at 73.50. Okay, the expiry is on 25th of November. So the contract size will be 100 contracts because the lot size in terms of dollar is 1,000. So 100 contracts will come. He takes a long position on the currency. That means he buys futures at 73.5. He's bullish on dollars. He expects the dollar to go up. Fine. For doing so, he has to pay a margin of 3%. Fine. Say he has to pay 3% margin, but now he doesn't have any underlying position. He's neither exporter nor importer, neither is receiving money from abroad, nor he is going to make a payment abroad. So he's just purely speculating. So he takes a long position. Okay. He gets into a contract to buy dollar at 73.50. He thinks the dollar will go up and he's going to make money. So he enters into a contract with someone to buy the dollar at 73.50. If the dollar goes up, he makes money. If the dollar goes down, he loses money. So let's Now take an example here. So suppose he waits till 25th of November. Okay, fine. So we'll do a scenario where he will not wait, he will even, square up his transaction must go. So that will be after that. Assume the rate is 75 rupees, reference rate of the RBI. So he makes a cash profit of 1 lakh profit, 1,20,000. So since he has taken a long position in dollars, dollar has gone up to 75, he makes money, 1,20,000. So margin will get released. Futures are cash settled, no delivery required. So he will purely get 1,20,000 and he will, get his margin. Now let's assume the dollar weakens. So it is against his, his bet. So he's going to lose money, $1 lakh. The margin will get released. So futures are cash settled. So in this case, he's going to make a loss. Fine. Yeah, no profit, no loss. Yeah. In case of, what happens when you are, you're hedging yourself, then, you book there is no loss or gain. So that's a very good, Sumit, your point is that there will be no profit, no loss. Fine. So there will be no loss on account of any foreign currency fluctuations. So in futures contract, neither you make money nor you make loss on account of, when you hedge yourself. Okay. So if if you're in profit in the stock market, you can't, actual sense you're not making because you're losing on your underlying transaction. Okay. If you're losing in the stock market, but in the underlying transaction you're making a gain, so those things will get neutralized. So which will mean that there is no profit, no loss. So that's a very good observation. So there is no profit, no loss. Now the margin 3% is fixed. Yes, it depends upon the volatility of the currency. Okay, and presently maybe around 3%, but it may keep changing because the stock exchange wants to make that these transactions there is no default risk. So they will collect appropriate margin from both the buyer and seller. Okay, fine. So this 3% is not fixed always. It will keep changing depending upon the circumstances, depending upon the more volatile is the market, the more margin will be collected because there is a great chance of making loss or profits. So, stock exchange, wants to honor all these commitments, so they should have appropriate kind of security margin with them. Okay. So, example on speculation using currency. Okay. So now, he's a bearish. So first he was, bullish. So X is a speculator. He's bearish on the dollars. On 15th October 2020, X wished to bet on 25th November 2020 contract. So he is actually bearish. So future is currently trading at 73.65, expiring in 25th November. Number of contracts same. So he takes a short position. So he is bearish. He wants to take a short position and sells currency futures at 73.65. So here, he's taking a short position in dollars. Because he wants to sell the currency futures, so he sells the currency futures. So he's bearish, he's taking short. Okay, he sells at 73.65. So margin is 3%. He pays, which is 2,20,000. Okay, so the first scenario, assume that the dollar goes down to 72.15. So he's bearish. So dollar has actually come down. So he's making money. Okay, so he makes a cash profit of 1,20,000 because he has entered to sell at 73.65 in his future contract. He has sold to someone at 73.65. The dollar has come to 72.15. So he is making a gain by shorting the dollars. So he will get 1,20,000. Margin will get released. No delivery required. So he makes some money and he keeps his profit for 1,20,000. Okay. So assume now that the dollar is gone up. Okay. So he's bearish, but the dollar has gone up. So in this case, he's going to lose his money. How much? 1,20,000. So margin will get released. He has to make a payment of 1 lakh. He's merely a speculator. He actually makes a loss because here he was bearish, but the dollar turned out to go up, and he lost 1 rupee 50 paisa, and he has to make that payment to the stock exchange. And his margin will be given to him, but he has to pay 1,20,000. So no delivery, only cash settlement. So he pays 1,20,000, and also the margin will be released by the stock exchange. So this is, so we now heading for a break for 5-10 minutes. So any questions? In case of speculation, if the loss, then yeah, of course, that can happen. That's a technical thing. Okay, fine. So, but just to explain that, both the transactions separately, I have done it. Fine. now we have a break and for 10 minutes. So we will meet exactly at 9 o'clock. So see you then at 9 o'clock. Okay. Okay, so we are going to start again. So we are going to talk about, currency derivatives. Currency derivatives also called FX futures. So they call FX futures also is a future contract to exchange one currency for another. Okay, so this is a contract to exchange one currency with another. So let me see. Okay, so I'm looking for some kind of, will this futures contracts are MTOM? Okay, so we'll discuss that. They are mark to money market, mark to market. Okay, so we'll talk about that. So just wait for some time to understand the spec. When we do all this, contract specifications, we'll cover all that. Okay, so we are going to cover the same thing which you're talking about. So is a future contract one currency another? Okay. At a specified date in future at a price that is fixed on the purchase date. So currency derivative basically is also known as FX future, is a future contract to exchange one currency for another. First of all, it is done to exchange one currency for another at a specified date. So you choose the date. So it can be, any date. It can be in the month of January, it can be month of February, it can be month of March, it can go up to right up to December. So the futures market, particularly in India, they give you 12 monthly contracts. Okay, so you can choose any contract, and the price that is fixed on the purchase day. So you choose the price yourself, and you enter the price to enter into the contract. It should be almost similar to the price which is prevailing now. So to get the order executed. Okay. Now, on the stock exchange, the price of the future contract in terms of INR per unit of other currency, for example, dollars. So basically, you get the price in terms of INR per unit of currency. So whether it is dollar, whether it is euro, whether it is yen, whether it is, so you'll get a direct, quote there in terms of any foreign currency. Currency future contract allows investors to hedge against foreign exchange risk. So basically, this is a mechanism to help basically to hedge yourself against the exchange risk. So now we're doing yet another example. Okay, fine, because the contracts can be closed anytime till the expiry. So let's understand if the speculator is using the currency futures and making a profit much early, so you can close this position before even the expiry. Whether you are a speculator, whether you are a hedger, you can do that. Okay. So X is a speculator. He's bullish. Okay. So he's bullish. He's a speculator and he's bullish. So he'll take a long position, isn't it? So he takes a long position. Let's understand. So on 15th October 2020, X speculates for 25th November 2020 and contract worth $1 lakh. So he's a bullish guy. So he wants to take a long bet on dollars. Okay. So today is 15th of October. So he is thinking that, in the month of November, the dollar is going to make a rise. Dollar is going to go up. Okay. So currently dollar is trading at 73.5. So expiry is on 25th of November. And the total contracts he is going to take a long position will be 100 contracts. Okay. So he takes a long position in the currency. That means he buys futures at 73 point. He will make money only when the dollar rises. Okay. So he pays a margin of 3%, which is 2,20,000. So here we are taking that he's a speculator using currency futures. So he will not wait till the expiry of 25th of November. Okay. He will like to close if he is making money. So let's understand. So booking profits before expiry. So on 27th October, okay, the November future contract is trading at 75. Fine. So when he bought, it was 73.50. So the last traded price in October, when he saw the screen, it was 75. So he says that he's already making a money. So very soon after booking his contract, he squares up his position to book profit. So what he's going to do, in technical terms, in stock exchange language, it is called square up his position. So that means if he has bought early, now he's going to sell. Okay. So he's going to enter into another contract to sell the dollars. So squaring up means taking a position, opposite position in the same contract month. That means in the month of November, he's taken a buy position. Okay, he's going to now sell in the month of November. So he takes opposite position. It's a different contract. Okay, with someone else. Fine, not with the same guy. Normally not with the same guy. Okay, so he squares up his position. Now he sells 100 lots at 75. No margin is required because it is a second position, second leg. Okay, for the squared position. So that means he immediately, when he enters into a squaring up position, okay, he makes a profit. First he bought at 73.50. Now he takes a sell call on 75 by entering into another contract with someone else. So which means his position is making a profit of 1,50,000. So this is called squaring up position. Whatever position you have taken earlier, you will take the opposite position. If you have bought earlier, you will be selling now. If you have sold earlier, you will be going to buy now. So margin will get released and he will make a profit of 1,50,000. So you can even, close your contract anytime before the expiry of the month. So in this case, the expiry of the month was 25th November. So you get a right to buy the dollars, in this case example, on or before 25th of November. So you can wait till the month end, or you can, do it even early. If you are making profits as a speculator, you will immediately like to, book your profits. And if you're a speculator and you are making losses, and you assume the losses will magnify, you're going to cut short your losses also. Okay, so you're going to close your positions, either way to make more profits or to cut your losses. So this is what he has done. Okay, so now we will go and understand one by one all this, contracts specifications. Okay, and understand about these currency derivatives, particularly with respect to India, but some knowledge with respect to abroad will also be given lately. So derivatives are available for 4 currency pairs in India. Okay, in the Indian stock market through the National Stock Exchange: US dollar, Euro, Great Britain, Pound, and Japanese yen. And also the cross currency pairs are also given: the Euro, USD dollar, so Pound, US dollar, Japanese are also available in the derivative segment of the National Stock Exchange. Okay, fine. Currency future contracts specify a standard volume of a currency. Standard volume of a currency. That means, it will be in multiples of, $1,000 or 1,000 euros or 1,000, pounds. In yen, it will go to 1 lakh yen. Okay, we'll talk about the lot size of the yen also later on. So they are used by multinational companies to hedge their currency positions, and by speculators who hope to capitalize on expectation of exchange rate movement. So it can be used both by the multinational companies as well as, to hedge their currency positions, or to take as a speculators who, want to make money, quick money, because if they have any view on the currency. So they are both speculators as well as, hedgers present in these markets. Normally the speculators always outnumber the hedgers in any market, and would be the same case in this currency markets too. The contracts can be traded by the firm or individuals through brokers. So anybody can go into the foreign currency market. And I show you my screen. So even, as an individual, you can, enter into futures and options market also as an individual. Okay, but the lot size is, $1,000. Fine. But when you go for a forward contract, it has to be, big amount, more than this. Okay, so individuals can even, on $1,000, which will be equal to about 75 lakh rupees or 74,000 rupees. So fine. So even with that small amount, you can take a call on the dollar or any currency. But if you have to take a forward contract, then the bank will never entertain for such a small amount. So that's the the advantage of futures contract, because it is available at start with $1,000. Okay, the contracts can be traded by a firm or individuals through brokers. So we always take the help of a broker, like I showed an example of ICAI Securities, where you have a trading account with them, so you can access to these portals of National Stock Exchange. So these are through national stock exchanges, in India. Participants in the currency future market need to establish and maintain a margin when they take a position. So this we have explained that you have to pay a margin. Of course, this margin will get released after the contract is over. You make a loss or profit. So along with that, the margin will get released, and whenever you take a position, and you have to maintain these margins. And the margins are currently approximately to the tune of 3% in dollar terms, dollar rupee pair, but it can always change with respect to each currency pair depending upon how volatile is the currency. More volatile, more risk. So the stock exchange will like to charge more as a margin, as a safety measure, so that the transaction is through without any default on either side of the agreement. So the buyer and seller are supposed to pay margins. Okay, fine. So in National Stock Exchange, currency futures contracts allow investors to hedge against foreign currency risk. Fine, and this we have done. They are available for the 4 currency pairs, as well as the cross currency contracts are also available. Okay, so there are 4 currency pairs today, as well as couple of cross-currency pairs are also available in the National Stock Exchange. So now let's understand, some of the specs. These are very important. So please focus, because these will be very handy for your exams also. So because these always appear. Now first of all, it's called the tick size. If you remember, we did pips in the forward market. In the stock markets, we have ticks equivalent to the pips. So this is 0.25 paisa, or INR 0.005. So it is equivalent to pips. So that is the minimum movement which can happen in the currency, in the futures market. So while you're placing your bet, it has to be in line with this, tick size. Okay. Trading hours of these stock exchanges are between 9 to 5 p.m. Okay. Again, stock exchange, it is 9 to 3:30 for stocks, but for currency, it opens from 9 till 5 p.m. Okay. Contract trading cycle, 12 months trading cycle in India, National Stock Exchange. You have 12 monthly cycles, depending on which month you are betting on. So whether it can be January, February, depending on when you are going to receive money or when you are going to make the payment. So you have to choose that contract, okay, month to enter into the into trade. So the last trading day, 2 working days prior to the last business day of the expiry month. So there's a question which was asked by, I think, by Sumit. Okay. So Sumit, this is answering your question. The last trading day is 2 working days prior to the last business day of the expiry month. The final settlement day happens last working day, okay, as against the last Thursday of the month in case of stock market. So it is going to be last working day, excluding Saturdays of the expiry month. So the last trading day means when you can place a bet. Either you can go long or short. It has to be 2 days prior to the last business day. Okay. And the settlement happens on the final settlement happens the last working day, excluding Saturday of the expiry month. Now there are 2 kinds of settlements which are happening. Daily settlement, okay, which is called the mark-to-market settlement, and the final settlement. Okay. So daily settlement takes place in the stock exchange. This is to ensure, a kind of a default-free, riskless trade. If you're making money, you will be given the money. If you're making loss, you have to, go and deposit that loss to the stock exchange. It happens on a daily basis. Okay. So daily settlement price basically is calculated on the basis of the last half an hour weighted average across exchanges. So how to determine, whether you have made a loss or gain? The profits, the settlement price has to be calculated on the last half an hour, because, a lot of volatility can happen in the last half an hour. A lot of speculation, a lot of, manipulations can happen. So it is a weighted average price, which is, taken as a price for calculating your final settlement, whether for the daily settlement, whether you're making a gain or loss on a daily basis, whether the money will come to you or money will be taken from your account. It will be depending upon the last half an hour weighted average price of the currency pair. The final settlement price is, of course, the RBI reference rate, okay, fine, which is close to the spot rate prevailing on that day. Now, the contract size for dollars, it is $1,000, okay, US INR pair, When you look at the euro INR pair, the lot size is 1,000 euros. When it is the pound, this thing, then it is 1,000 pounds. Okay. Then for yen, it is 1 lakh yens. Okay, fine. So yen exception is 1 lakh yens, but for all other currencies, this 1,000 is the lot size. Then settlement of futures. Currency futures in India are cash settled and not physically settled. So as we know, the settlement takes place is cash settled, and they are never, physically settled. So you either make money or lose money, and you either pay in cash or take in cash. The dollars are never given to you by the exchange, nor the dollar you have to give the dollars to them. Okay, so it is only the cash settlement which takes place. Fine. For your settlement of your dollars, commitment or receiving dollars, you have to go to the bank, okay, and use the spot rate. So basically, you are hedging here through by taking up positions. So settlement, I told you that there is a daily settlement and a final settlement which is happening. Now, why it happens? Because stock markets wants to ensure that there is no default and everything is settled on a daily basis. And if something is left, it is settled on the final basis, final settlement. Now, if you don't close your currency future contracts before expiry, so either you can close it before the expiry by taking by squaring up your position. If you're taken a buy call, you can sell. If you are sold, you can buy to close your position. But if you don't do that, then the RBI reference rate will be considered as a closing price. So if you don't close your currency future contracts before expiry, the reference rate fixed by RBI will be considered as a closing price. Okay, so you can go right up to the closing and don't close your position, then it will get automatically closed by the stock exchange using the RBI reference rate on that day. Okay, otherwise you have a choice to do that 2 days prior to the closing. So final settlement price is the RBI reference rate. Okay, so RBI gives a rate. Okay, so that rate is chosen as the final settlement price. So exchange rate is published by RBI in its press release, captioned as RBI reference rate for US dollar and euro. So the RBI keeps coming out with these rates, okay, and these are called RBI reference rates. Okay. Now, as one of the person was talking about whether the daily M2M settlement happens or not. So daily mark-to-market settlement is happening, okay, in the currency markets. So one of the important features of the future contract is the gains and losses are settled on each trading day. Okay. So on every day, if you are making a gain, the gain will come to you. If you're losing, you have to make the payment. Okay, so this is a strict mechanism. Okay, this is a risk mitigating mechanism of the stock exchange. Okay, the exercise is called mark-to-market settlement. So this is called mark-to-market settlement. This means the value of the contract is marked to its current market value. Fine. So the value of the contract will be marked to its current market value. If you're making a profit, you will get it. If you're making a loss, you have to make the payment. So the exchange, with the help of brokers and clearing houses, could collect the margin. So the stock exchanges keep collecting the money. Okay, if it is required, if you're losing, so you have to pay more from the loss-bearing party and would pay the same to the gain recipient party. So if you're making money, if you're gaining, you will get it. But if you're losing, then the money will be collected from the loss-bearing party and paid to the party which is making the money. Okay, so the final settlement now on the expiry of the futures contract. So the National Stock Exchange clearing marks all positions to the final settlement, and resulting profit loss is settled. So then finally, the final settlement also happens if there's something left which is not covered under the daily settlement. Then the final settlement will take care, because it is the gap of 2 days. So the final settlement is required. So final settlement profit loss is computed as the difference between the trade price of the previous day, as the case may be, and the RBI reference rate. Okay, so then that means at what price the last settlement, daily settlement taken. So that price and the RBI reference rate. So that may be. So this is just for this thing. There are no questions asked generally in your CA exams with this regard. Okay, so final settlement is debited or credited to the relevant bank account on T+2 day. Okay, the last trading day. So daily settlement price for the future contract is closing price of such contract on the trading day. So daily settlement happens on the last closing price, is the closing price of such contract in the trading day. So this is half-an-hour closing price. The closing price for the future contract shall be calculated on the basis of the last half an hour weighted average price across exchanges of the contract, which I have already covered. Okay, so now this covers basically the futures market, but now we'll be doing some questions from your practice manual. But before we do that, let's talk about difference between the two. The contract size is customized in the forward market, and in futures market it is standardized. Why so? Because there are lot sizes in futures market: $1,000, €1,000, 1,000 pounds, or 1 lakh in, but no such case in case of forward market. So you can have a perfect hedging for whatever amount you have. Suppose you have to pay 5 lakh, 26,750 dollars. You can do it, okay? But in futures market, it has to be to the tune of $1,000, okay? So you have to just divide by the total, exposure and divide by 1,000. So you may get some odd contracts. So you can either be over hedged or under hedged, okay? Fine. So you will never be fully hedged in the futures market. So either you have to take a higher hedging position or a lower hedging yourself, okay? Then trading informal over the counter in case of forward market, and in the future market it's always traded on the exchange, either the National Stock Exchange or the Bombay Stock Exchange or New York Stock Exchange or any exchange in the world, okay? It always happens in the stock exchange. Participants in case of forward markets are banks, brokers, multinational companies. Public speculation is not encouraged. Okay, so there are no speculators present in the forward market, but in case of future market, it's the speculators and hedgers both, and normally the hedgers, the speculators outnumber the hedgers. So here also the bankers, brokers, MNCs, and qualified public speculation encouraged. Okay, so settlement single pre-specified in a contract. So in a forward contract, there is only one settlement which takes place on the day when you have to either make a forward payment or a forward receipt. So on that day, the transaction, it will be settled. But here in the futures market, there will be a daily settlement and the final settlement. This is purely a mechanism to make sure that there is no default. Okay. Risk, counterparty risk is present in the forward market because the two parties, one party can always, back out. Okay, and you have to take a legal recourse, go to the court for settlement. But in case of futures, provides a guarantee of settlement and hence no counterparty risk, because the mechanism is such that there is a daily settlement, final settlement, margins. All these help the exchanges to smoothly settle the transactions between the two parties. Whereas in forward markets, there's always a risk of a threat of a counterparty. Marketplace, worldwide digital network, telephone network in case of forward markets, but in case of future markets, it happens on the floor of the exchange through a online trading account. You can enter into a futures market transactions. So so now we come to the practice questions. Okay. So before we do that, so let's test your knowledge. Okay. So I will be entering into the MCQ arena. So which will, you will be able to understand. Okay, so let's do some questions. Okay, so you have to answer these questions. So I'll give you some time. It'll take about 10 to 15 minutes to cover that. Okay, so now the first question: using futures contract to using future contracts to transfer price risk is called what? Using future contracts to transfer price risk is called what? Diversifying, arbitrage, speculating, hedging. So please answer this question. Using futures contract so the first question is this. So please answer. Okay. Using future contracts to transfer price risk is called what? Diversifying, arbitrage, speculating, hedging. What should be the right answer? So the answer is hedging. I hope the screen is visible. Let's see. Okay, so first, yeah, you are able to see that. Okay, fine. So I'm getting some answers. Preeti, yeah, your answer is right. D, absolutely, Srinivasan. So, okay, next question. Hedging risk for a long position is accomplished by taking another long position, taking a short position, taking additional long and short position in equal amounts, taking a neutral position, none of the above. So hedging risk for a long position is accomplished by taking another long position, taking a short position, taking an additional long position, taking a neutral position, none of the above. So please answers, please. So yes, Sumit is absolutely correct. Sumit, your answer is correct. Your answer is D. So Srinivasan has given right answer. Preeti has given right answer. Uh, okay, Ambika has also given the right answer for the first one. Great. So Chavi, second is 2B, taking a short position. Yes, it seems to be right. Yeah. So let's see. So yeah, taking a short position is the right answer. Great. Hedging risk for if you have a long position, then you should take a short position in the futures market. So that I explained to that. Okay. So let's do the question number 3. Hedging risk for a short position is accomplished by taking a long position, taking another short position. So please, the answer should be very simple now. Since you have answered the first question correctly. So what should be the answer for the third MCQ? So hedging risk for a short position is accomplished by taking a long position, taking another short position, taking additional long and short positions in equal amounts, taking a neutral position, taking another short position. Yes, it seems to be right. Yeah, 3A. 3A, taking a long position. Yeah, taking a long position is always right. Yes, Chavi, you're right. Ambika, you're right. Srinivasa, you're also right. And Preeti, you're also right. Wonderful. So let's go to the fourth one. A contract that requires investor to buy securities on a future date is called what? A short contract, a long contract, a hedge, or a cross contract. A contract that requires the investors to buy securities on a future date is called what? When you buy a futures contract, that means what? You're taking a long contract, you're taking a short contract, you're hedge, or you're cross. So the fourth one, contract that requires the investor to buy securities on a future date is called a short contract, a long contract. Yeah, I've got some answers on the fourth. The answers are mainly you are given. Let me check the answer. The answer is B. Okay. So Chavi has given it right. Ambika, you're also right. And Srinivasa, a contract that requires us to buy securities, and you're buying, you're taking a long position. Okay. So you're not taking a short position. But when you sell it without owning it, so it's called short position. Okay. So here the answer should be the B, which is long. Okay. Now let's go to the fifth. Hedging in the futures market eliminates the opportunity for gains, eliminates the opportunity for losses, increasing the earning potential of the portfolio, does all the above, does both A and B of the above. So if you remember, somebody asked a question earlier, whether you don't make either a loss or profit. Okay, so this is a hint for that question. So please answer. Okay, so Sumit, you're right. So please, Sumit, you only ask this question. Remember, you asked a question which is relevant to the MCQ number 5. Hedging in the futures market eliminates the opportunity for gains, eliminates the opportunity for losses, increases the earning potential of the portfolio, does all of the above, does both A and B of the above. So what should be the answer? Please think. So the fifth one, okay. Fifth is D, you said, does all the above. Okay, so the answer here is E, which says that does both A and B together. Okay, so the answer is actually E. Okay, Sumit, yeah, E. Chavi said E. Yeah, you're right. Srinivasa, it's not D. That's all about. No, increase the earning potential of the portfolio. Never. If you're hedging in the future market, neither you make a loss nor you make a profit. Okay, so it eliminates the opportunity for gains. It eliminates the opportunity for losses. So both are correct, A and B. So that means the right option should be E. Okay, so Preeti, it's not the answer D. Okay, does all of them? No, it is. The answer is the E. Okay, so now let's look at this question. Okay. On 15 January, Mr. Ramit Seth bought a January USD INR contract, future contract, which cost him $73. Each USD INR future contract for delivery of 1000 USD, the RBI reference rate for final settlement is 73.10. How much profit loss does he make? So just calculate. So he has bought. So how much profit does it make? Sixth one. Sixth is B. Yeah. Chavi, you're right. Absolutely right. The answer is $100. Okay. So Chavi, you're right. Absolutely right. The answer is $100. That's correct. Okay. So because you have bought it at 73 and today the price is 73.10, so you have made a 10 paisa. So 10 paisa multiplied by $1,000 will give you $100. Okay. So that's the rate. Fine. So Chavi is right. So now let's go to 7. Presume Mr. B is expecting a remittance of rupees 10,000, US $10,000 on 28th of August. Wants to lock in the foreign exchange rate today so that the inflow of Indian rupee is safeguarded. B can do so by buying 10 contracts, selling 10 contracts, selling 10,000 contracts, buying 10,000 contracts. So he's expecting a remittance. Okay, he's going to expect. So he's like a exporter. So what does an exporter does? An exporter is always has a long position. So you should always take a short position. Fine. So that's a hint. Let's see. So yeah, Srinivasa, your answer is right. Ambika, your answer is right. Preeti, your answer is right as far as the question number 6 goes. Wonderful. So let's talk about 7. What will you be doing? Mr. B is expecting, some money, a remittance of $10,000, okay, on 28th of August. Wants to lock in the foreign exchange rate today. So Mr. B is expecting a remittance of $10,000 on 28th of August. Wants to lock in like foreign exchange rate today. Okay, so seventh answer is Srinivasa has given A, B. So he is going to actually, sell contracts. Okay, the answer should be B. So Preeti, you're right. Chavi, you're also right. But Srinivasa, just check it is not A. Buying 10 contracts will not help him basically, because then he will be taking a long position. Okay, he's already long in the dollars. He's going to get dollars. Okay, he can't take another long position. Fine. So it has to be just the reverse of that. Okay, so it has to be B. Great. So Chavi, you've done it right. Preeti, you've done it right. Okay, now let's look at A. Which of the following actions will offset a long position in the futures contract that expires in June? So which of the following action will offset a long position in the futures contract that expires in June? Sell any futures contract regardless of the expiration date, hold the futures contract until it expires, buy a futures contract, sell a futures contract that expires in June. So please, question number 8. So very important. If you answer this, I think you have understood today's chapter. Okay, so question number 8. Okay. Question number 8. So, which of the following actions will offset a long position? So, please answer this. Okay. So, I told you if you have to offset, you have to take an equal and opposite position in the same expiring month. If you remember while we were doing the question. Okay. So, this will help you out to answer this question. So, question number 8, I am expecting some answers to come quickly. Okay. So, the answer is basically sell a future contract that expires in June. Okay. So, the answer should be sell a futures contract that yeah, E, yeah, right. So, most of you have given the right answer. Chavi is right. Ambika is right. Sumit Jain is right. As well as Preeti is right. Okay. Fine. So, the answer 8 is correct for most of you. Now come to the question number 9. Which of the following does the most to reduce the default risk for the future contracts? Mark-to-market settlement, high liquidity, credit checks for both buyers and sellers, flexible delivery arrangements. So which of the following does the most to reduce the default risk for the futures contract? So question number 9. Okay, so I expect some answers from you. Which of the following does the most to reduce the default risk for the futures contract? Mark-to-market settlement, high liquidity, credit checks for both buyers and sellers, flexible delivery contracts. So 9th answer is A. Yeah, 9th is A. Absolutely correct. Okay, so now the last one. Amul Limited purchases coca to make its product. The company is concerned that the prices may rise prior to piling of inventory for Diwali sales. It is forecasted that the price of per ton would vary between $12.50 to $1,500, and October futures contract can be obtained at $1,300. What is Amul's risk in this situation? Coca price will rise above 1,300 and Amul will purchase its coca at a price of 1,300. Okay. Coca price will decline below 1,300 and Amul will have to purchase the coca at 1,300. Coca price will hit 1,300 and the contract was a waste of time. Amul has no risk in this situation. So please answer this question. Okay, this is a good question. So this company Amul, he is going to, they are going to, yes. So 9th was basically mark to market. Yeah, A was the right answer. Okay, so 10. So now we have the question number 10. Okay, fine. So 9th. Okay. 10th is, this company is going to purchase coca, for making chocolates. The company is concerned that the prices may rise prior to, making an inventory for Diwali sales. So it is forecasted that the price per ton could vary between 1,250 to 1,500. So October futures contract can be obtained with 1,300 purchase price. What is Amul's risk in this situation? So they are entering into a future contract at 1,300. So that means they are going to buy at 1,300, whatever so happens. So coca will decline below 1,300. Amul will have to purchase the coca at 1,300. Coca price will rise above 1,300 and Amul will purchase the coca at a price of 1,300. So yeah, absolutely. I think some answers I'm getting right. So 10th, Chavi, B. So let's see B. Yeah, B is the right answer. Why? Because, if the price declines below 1,300, still Amul has to buy the coca at 13 because it has entered into contract to buy coca at 1,300. So, whatever happens, the price is going to be 1,300. Even if it falls, he still has to pay $1,300. Okay, so that's a risk. So the risk which remains is that if the price of the coca comes down, still Amul will be buying at 1,300. Okay, fine. So this is, this was a little tricky. So Preeti has answered correctly. Chavi has also answered correctly. Sumit, so kindly just relook. So this is a normal thing which happens. People make mistakes. So don't worry. So coca price will rise above 1,300. Will purchase coca at the price of 1,300. So it looks to be right, but actually it is not the risk. It is a profit basically. Coca price have gone up 1,300, but what happens is that the price will rise above 1,300 and Amul will purchase at 1,300. It's okay. He is fine. But that is not a risk. Risk is the coca price will decline below 1,300 and he still have to purchase at 1,300. Coca price will hit 1,300 and the contract was waste of time. So that is not right. Amul has no risk. No, Amul has a risk because if the price goes to say $1,000, but it has to still purchase at 13, isn't it? So that's the risk. So that covers our MCQ. So now we just move on to do some couple of more questions. Okay, one or two more questions. Okay, and then we close our day for the day. So this we were in the practice questions. Okay. Okay, so we will be doing one more questions before the day ends. Okay, fine. So let's talk about that. So ABC Technologic is expecting to receive a sum of $4 lakh after 3 months. Okay, so this company is expecting to receive $4 lakh after 3 months. Fine. So they are exporters basically. So you remember that they are exporters and they are going to receive money after 3 months. Company decided to go for a future contract to hedge against the risk. So company has decided to go for a future contract. Now, since it is an exporter, so they are a long position, so they'll take a short position. Okay. So just to visualize what's going to happen, they're going to take a short position in the futures market. The standardized size of the future contract available in the market is $1,000. Okay. As of date, the spot and futures contract are quoting at 44 and 45. So the spot rate is $44 rupees per dollar, and the future rate is $45 per 45 rupees per dollar. Okay, so this is the futures rate. Okay. Suppose after 3 months the company closes out its position. Right. Futures are quoting at 44.50 and spot rate is quoting at 44. Normally I said they are almost equal, but it can happen because the futures are basically depending on the RBI reference rate. Okay, and the spot rate may be slightly here and there, but normally they are equal. The futures are quoting at 44.50 and the spot rate is also 44.50. You are required to calculate the effective realization for the company while selling the receivables. Okay. Also calculate how company has been benefited by using the future option. So this is basically the question which we have to answer. Okay, so ABC is an exporter. He's going to receive the money after 3 months. Okay, and the lot size is $1,000. So we know that. So 4 lakh divided by 1,000, so that will be 400 contracts. We know that. Okay, so let's see. Let's solve the question. The company can hedge position by selling futures contract. Okay, because they are going to sell in the futures market because they are exporters, so they are going to receive the money. Okay, but they can do it by hedging by selling the futures contract. Sell currency futures at 45. So today's day the futures are selling at 45. So we just check. If you look at the spot and future contract are quoting at 45. So look at this, it is 45. Okay. So at this rate, he's entering into for selling futures. Okay. Now the number of contracts required will be 400 contracts. Okay. Fine. So after 3 months, the future price is going to be 44.450. Okay. So we know that after 3 months, the price is 44.50. And the spot price is also 44.50. So this is given the question. So he has sold his currency futures at 45, and today the price is after 3 months the price is 44.50. Okay. So what he's doing, is he making a gain or a loss? So he should be making a gain. Okay, because he will be closing at 44.40 because he has taken a short position, and the dollar has also depreciated to 44.50. So gain by trading in the futures. How much? 50 paisa. 50 paisa multiplied by 4 lakhs gives you a gain of 2 lakh rupees. So he's going to make a gain of 2 lakh rupees here. Okay. So net inflow after 3 months, because he's going to get now his money. Okay. Because the spot rate is 44.5. So he's going to get, 4450 into $4 lakh plus the 2 lakhs. So put together, he gets 1 crore 80 lakh. Okay. So which is, in the spot market, because the rate is 44.50. So he goes to the bank and sells his dollars, $4 lakh. So bank is going to give him 44 rupee 50 paisa. Okay. So plus the 2 lakh, which is going to gain from the stock market. So to put together, he's going to get 1 crore 80 lakhs. Okay. So the effective price realization would be then 1 crore 80 lakhs divided by 4 lakhs. So it is 45 rupees. So since he has sold his currency futures at 45, so that becomes the hedging rate. So he's going to get a realization at 45. Whatever happens, he's going to get 45. Whether the currency weakens or appreciates or depreciates, okay. So he's going to be fixing his remittance. He's going to receive the money only at 45 rupees. So this is the answer of this question. Okay. So then we can look at. I solved it. Because how it is given in your study material, the company can hedge by selling futures contract as it will receive amount from outside. Okay. So number of contracts will be $4 lakh dollars. Okay. And $1,000. I'm just redoing this question in a different format. Okay. And then number of contracts will be $4 lakh divided by $1,000. There are 400 contracts. So gain by trading in the futures contract, how much? There's a 50 paisa gain because he has taken a short position. Okay, in the futures market. So he makes a gain of 2 lakh rupees. So he gains 2 lakh rupees in the stock market, and but his net inflow after 3 months will be 44.50, which is the actual rate, into 4 lakh plus the 2 lakh rupees, which he actually made a gain. So overall, he's getting money at 1 crore 80 lakh rupees. Okay, so effective price realization would be 1 crore 80 lakhs divided by 4 lakhs, so which is 45 rupees. So this is the rate at which he is going to get his money. Okay, fine. So okay, so this question we will be doing next time. So I'm just going to take you through the specs again a little bit. Okay, so because the last question is going to take time, we'll not be able to complete that within the time foreseen. So let's understand some of the specs again. Okay, so this is just a revision. So currency futures contracts are basically currently specify a standard volume of currency. So the contracts can be traded by a firm or individual through brokers. So you have to use the help of a brokers to go to the stock exchange. Okay, they are automatic trading systems. So you have to just log in, either take either you can buy or sell currency through the platform, either through National Stock Exchange or through Bombay Stock Exchange, and they are always through the exchange mechanism. And participants in the currency futures need to establish and maintain a margin. We all know that. So they have to maintain a margin. Okay. So if you have any questions, so please ask. So let me see if there is any question. If it's there. Yeah. If there are any questions, please do ask me. So it's the right time to ask the question. Currency futures contracts allow investors to hedge against the foreign risk. We know that. And these are the pairs of currencies which are traded in the stock exchange. So they are both the 4 currency pairs and the cross currency pairs. Both of them, kind of currency pairs are traded. So now this is very important. Tick size is 0.25. Okay, we have the pips in the forward market. Trading hours are 9 to 5. Contract is their 12 monthly cycles, which are always there. Last trading day, we know that. Okay, final settlement happens. Daily settlement price, how it is calculated using the weighted average price across the exchanges. Final settlement price is always the RBI reference rate. Contract size 1,000 contracts 1,000 US dollars for the USD INR pair, and 1,000 euros for Euro INR pair. Okay, and then we have then pounds also. There are 1,000 pounds pair. Okay, then 1 lakh yens for the Japanese yen. Okay, then settlement of futures, currency futures in India, cash settled. So this is very important. You know, when you are entering into the futures market, there is no physical settlement happening. Okay, so you either pay amount in cash or you receive amount in cash. Okay, so they are always cash settled and not physically settled. So this you should always remember. The physical settlement takes, you know, outside the market at the spot rates. As an exporter, you will be going to receive money and going to the bank for getting your money. And as an importer, you go to the bank to pay the money. Okay, but here you will be getting either a profit or loss, which will actually hedge yourself. Okay, so settlement is daily and final settlement. If you don't close your currency futures contract, you know, you have a choice basically here. You know, you can either close your position before the expiry, or you can wait till the expiry. Then the RBI reference rate will prevail. Okay, the exchange rate, the contract will be, you know, settled at the RBI currency, RBI reference rate. But if you want to do it, you want to quit early, then you can always, you know, take an opposite position what you have taken early. If you have bought futures, you sell futures. If you have sold futures, you buy futures to close your position. So how that is out? It's called squaring up of positions. Okay, fine. Then the final settlement price is the RBI reference rate, exchange rate published by RBI in its press release all the time for these currencies. Then there is a daily market-to-market settlement, which is basically to, you know, make sure that there is no default happening, and there is no counterparty threat risk, which is actually available in the forward contracts. Okay, so the profits are given to the person who's making money, and the loss-bearing party needs to, you know, would pay them out. So this happens on the expiry of the futures contract. Okay, through the National Stock Exchange. Then this we explained, this we did it. Okay, and then finally the settlement price is daily settlement price is based on there is a daily settlement and there is always a final settlement. Okay, and the differences we know. This is the last slide for the day. Okay, so this is very important. There are many questions which come in your exams. What's the difference between forward and futures market? So forward contracts are basically customized, whereas futures are standardized, or we say that forward are non-standardized. Trading happens over the counter in the forward markets, and in the futures market, it happens on the exchange, on the floor of the exchange. Here, the participants, we have one more participant in the futures market, that is a speculator, which is missing in the forward market. Okay, so speculation is not encouraged in the forward markets. Okay, whereas in future markets, always encouraged. Then there are, you know, there is one settlement which happens in the forward market, and there are, you know, daily settlement and final settlement taking place in the futures market. Then the risk, the counterparty risk is always present in the forward market, whereas in the future market it is missing because there is a mark-to-market settlement, daily settlement happening, and it is marketplace is basically the worldwide telephone network. Okay. In case of forward markets, and in the future market, it happens on the stock exchange. Okay, so there is a question. There are a couple of questions. On what factors fluctuation in foreign rates are based? On what factor fluctuations in forex rates are based? Now, there are a lot of factors. You know, it is basically the demand and supply which affects the fluctuations. Sometimes, you know, there is, it all depends, you know, if the imports are higher, the first and foremost is basically the trading, the import and exports are happening in India. If the imports are more than the exports, then there will be a, you know, pressure on the rupee, the dollar will appreciate. Okay. So if you have an unfavorable trade balance, it will, you know, push up the basically the foreign currency rates in India. Sometimes, you know, a lot of money flows out of India. Okay. The foreigners are pulling out of India because of, you know, because the COVID happened in the month of March or February. So a lot of money started flowing out of India. So the dollar started appreciating. Okay. And it is again the inflation which affects the foreign exchange rates. Okay. The higher the inflation, the higher the fluctuation will happen. Okay, the inflation keep changing, then the fluctuations do happen. So fluctuations are because of import export, the FDI money and FII money. Okay, if the money companies, if the country is receiving a lot of money through FII route or FDI route, so Indian currency will appreciate in those months. But it will be vice versa if a lot of money is flowing out of the country. So it is basically the demand and supply which affects the foreign currency fluctuations. Okay. Then question from Preeti. Sir, if overhedged, then it will be loss to the hedger? Okay, so if you are overhedged, okay, now we will understand this. This is a very good question from Preeti, that if you have 3,38,550 dollars of an exposure, and fine, if you divide it by 1,000, you get, I mean, 339 contracts. Okay, so so you will be covering a little more. Okay, fine. So either you will be overhedged or underhedged. So how to overcome this problem? Then you can always use a combination of forward contracts and a future contract to make sure your maximum cover will be through the future. Suppose you are trying to rely on futures. Okay, so to the extent you can cover, you cover. You remain a little underhedged in the futures market, and the balance amount you can take a forward cover. Okay, fine, if it is possible. Otherwise, I mean, you will be either overhedged or underhedged, as you rightly said. So we'll be doing some questions in our next time when we meet to cover this aspect what Preeti has raised. Okay, so do join us next time, and I will cover these your points, regarding the overhedge, underhedge also. So it's a very good question, but you have to wait for next class, which is going to be happening on 7th. Okay, fine. So there we end the class today. So we will be doing a couple of more questions on the futures, and then we'll be moving to the options market. So that we come to the end now. So see you then next time.